Start of cash equity trading. I'm Tom McKenzie in London. Francine Lacroix is in Cernobbio, Italy. And here are your top stories. Nowhere to hide. Equities kick off April mixed after an historically rough first quarter for stock and bond investors. Russia says it will keep supplying gas to Europe as it demands they shift payments to rubles. Ukraine-Russia talks are set to resume today. Plus, Euro area headline inflation is expected to reach the highest since the inception of the euro today, driven by a spike in energy prices. And it's jobs day over in the US. Let's take a look at the futures then. After a significant sell-off stateside yesterday, futures pointing range-bound here in Europe, gains between 0.2 and 0.3% as we continue to weigh up, of course, the talks between Ukraine and Russia, and of course the geopolitics is there, as is the central bank action. Is 50 basis points becoming the new 25 basis points for the next meeting for the Fed? Will the markets react to that and see that as a dovish move, because so much expectation is baked into that now as we wrestle with inflationary data, and we'll continue to keep across that for the Eurozone, looking like you could get up to 7% for the Eurozone with that inflationary data. The CPI, of course, in focus. The Spanish IBEX is gaining 0.4%. The FTSE 100 here in the UK gaining 13 points or 0.2%. The German DAX is also in positive territory, as is the CAC 40 up 0.2%. The oil story, of course, front and centre. We'll continue to look across that and see how that plays out across these sectors. Let's change the board and see how the futures are then positioning us for the open on Friday. As we look ahead, of course, to that US non-farm payrolls print, the survey is for a little under 500,000, so lower than we got in the previous month. And of course, how that factors into the decision-making of the Federal Reserve as it weighs up the tightness in the labour market with inflationary pressures and just how aggressively go on those rate hikes. We're also, of course, thinking about quantitative tightening. That comes later. Future stateside pointing to gains of 0.3%. We are close to yield inversion again between the 2s and the 10s. Currently the 10 at 238, a gain of 4 basis points for the benchmark. The Japanese yen is under pressure once again, trading at 122, lower by 0.6%. We continue to watch that differential between the BOJ and the Fed and how that weakens the Japanese currency. Crude at 98. This is WTI below $100 a barrel after President Biden said he would be releasing 1 million barrels a day for 6 months from those strategic reserves, down 2%. To what extent does that support equities then? Let's have a look at the individual movers that are in focus for us, some individual corporate stories. Santander coming out and saying that they are reiterating their target for 2022. They said the first quarter was solid. You're seeing gains of 1.7% for the Spanish lender. Stratec, this is a company that is seeing some offers, some bids from the private equity sector, and we'll see to what extent that plays into the pricing. It is a German company focused on the biosphere and whether or not there is indeed a final agreement. KKR is in the mix for that company within the bidding process. Sodexo, it's a French company involved in services, down by 4.4% after posting its earnings. So just a couple of corporate names. Francine is in Italy. Cernobbio been discussing the global economy, of course, the impacts of that war in Ukraine. Francine, the weather isn't ideal, but you're having some pretty insightful conversations there on the ground and trying to get a clearer picture of what the economic drag will be as a consequence of inflation and the war.
Right, I'm in Chernobyl, Italy. I need to remind everyone this is not Chernobyl, because for years a lot of people have been confusing it. And of course, given Chernobyl is back in the news because of what's happening in Ukraine, this is a very different kind of place. It's on the river, of course, the riverbanks of Lake Como. This is an economic conference. It's called the Ambrosetti Forum. And we have, first of all, some great guests coming on, but I'll also be interested to see what the conversation behind closed doors is among central bankers. So a little bit later on Bloomberg TV, I'll be speaking to the Ambrosetti Chief Executive Officer, Valerio De Molli. We also have an exclusive conversation with the Dutch Central Bank Governor, Klaas Knot, and then the European Commissioner for Financial Markets, Mrna McGuinness. Now, this morning, we already spoke to Mr. Elerian of Allianz. We also spoke to Laurence Boone, the OECD Chief Economist. And it's very clear, Tom, that when you look at some of the things that we need to watch out for is that if there's an oil embargo, so if we have a sudden shock, we could be looking at rationing. This is something that the markets hasn't really quite clocked on. So it will be up to governments, possibly in Europe, to decide what sectors they'll shut down, similar to what happened in COVID, and what remains open. But this time it would be just because of the higher energy prices. So I had a good conversation with Laurence Boone, and she says, look, the markets has not priced that in at all. They're discounting some of the longer term to medium term effects of the war. Now let's get over to our Bloomberg MLive managing editor in Singapore, Mark Cudmore. Mark, you're looking at inflation and, of course, economist expectations.
Absolutely, Francine. What a week to be at that conference, given what we're seeing on European inflation. It is European inflation this week, as all the data is coming through, and of course the changing scenarios because of the Russia-Ukraine war. We have the Eurozone-wide inflation print later on today, and as a result of that, I want to look how economists have done at forecasting inflation for 2022 and 2023 over the past year. So these are the consensus forecasts on Bloomberg. This is for 2022 full-year inflation. This is for 2023. So at the moment, they predict 2022 inflation will come through at 5.6% as the annual inflation number. Now, what's phenomenal is only 6 months ago to the day, 1st of October, they were expecting 2022 inflation would be at 1.6%. I'm struggling to keep a straight face just to show how far behind the curve economists in aggregate have been, and this is why the ECB is so far behind the curve. They've gone from 1.6% to 5.6% in 6 months. Where will their forecast be for the full year in 6 months' time? More importantly, what will they predict for 2023? 6 months ago, they thought that would be at 1.5%. 3 months ago, they were still saying that 2023 inflation would be at 1.5%. Now they've raised it to 2.1%. Maybe that line should be a lot closer to this one. There's a lot coming out in inflation later on today. Very exciting.
Mark Cudmore, you imagine there's some soul-searching going on within the economics profession as a result of the struggle to fairly predict the outcomes of these inflationary pressures. Thank you for breaking that down for us and what we may expect in 2023, whether or not that gap needs to close. Indeed. Managing editor for MLive, of course, Mark Cudmore, joining us out of Singapore. Let's get into some of the key market drivers then with our markets editor, Christine Aquino, and Maria Weitman, senior multi-asset strategist at State Street. Christine, let's start with you and just how you think and whether or not you think that the oil release that we got from President Biden is really going to move the needle when it comes to those inflationary expectations. Just to tie in what Mark was saying, does that make any difference materially to our inflation expectations?
That's definitely the big question that investors are asking, Tom. And depending on who you ask, the answer could be yes or no. But I think it really has to boil down to the fact that whether we see this release of reserves from the U.S. could materially change the overall supply of oil in the market. Because as we know, Russian oil isn't necessarily disappearing from the market. It's potentially being rerouted to other parts of the world. And then, of course, there's also the OPEC component to all of this. And whether they're also going to be aligned with what the U.S. is doing and whether they're going to respond in their own way. And so it's a really fluid situation. But I think, you know, at the onset, it seems like the interpretation of markets is that this at least kind of relieves that immediate cost-driven inflation, commodity-driven inflation that we are seeing in markets. We definitely saw some of those rate hike bets from for the Fed and various other central banks getting pulled back a little bit as a result of yesterday's news. But again, I think in terms of that rate cycle direction, the direction is still very much for tightening. It's just a question of the degree now of how much we're going to see.
And Maria, I know you've been the ever optimist when it comes to equities, when it comes to markets being able to weather this storm. Do you worry about an inverted yield curve, or should we not worry about it because of the extra stimulus that we saw in the last 10 years?
I mean, we absolutely have to worry about inverted yield curve. That's an important indication of what market thinks that how much Fed can, or other central bank can hike in the long run. I think in the medium term, shorter term, what gives me some confidence and some kind of optimism for equities, as I always do, is kind of underlying strength of earnings backdrop. I mean, to me, it's been incredible how over last months we've seen upgrades in earnings expectations across majority of the markets, like US and anything that's kind of a little bit away, a little bit disconnected from war in Europe has seen some kind of solid earnings. And I think there is some kind of disconnect between fairly robust corporate earnings backdrop with broader economic weakness.
Okay, and on that point, I want to bring you back in here, Christine. The PMI data that we have out of Asia, particularly China, is concerning, and a lot of it is not accounting for the lockdowns that we're seeing in Shanghai. The potential for China to be a global economic drag in this environment.
Quite huge, Tom. We know, of course, that it is the second biggest economy, and we know that even at the start of this year, that the PBOC was really keen to support the economy and going the other way as the other major central banks and actually ease because of the underlying issues in the Chinese economy. And you mentioned the lockdowns, which haven't even been reflected in these numbers. There is potential for even more negative numbers to come out as those lockdown impacts flow through to the real economy. We, of course, know that there is a bit of a lag here in real data, and so it's potentially a couple more months of even more kind of dour readings for the Chinese economy here, which is quite concerning for sure.
Yeah, so Maria, on the Chinese economy, but also on possible extra COVID lockdowns, the energy shock with the release also of the reserves from the U.S., what is the market at the moment discounting that they should pay more attention to?
Yeah, no, absolutely. I agree with Christine and kind of broader commentary that China is a very concerning point, and we know that Chinese authorities have ability to kind of move the dial with the wars, but I suspect they probably have much kind of bigger fish to fry at the moment, if speaking figuratively. So they still need to deal with COVID, they still need to deal with bond markets, they still need to deal with property markets, so equity is probably on a back burner. So that's a concern. We don't expect much kind of verbal intervention and much strong words from Chinese authority to help equity markets. So this particular market will probably be quite negative on. Other kind of what we are more positive on would be areas with stronger earnings. So to me, it's all about earnings. Earnings season starts in a couple of weeks. Which companies are strong enough to be able to pass higher costs, where margins are going to be strongest. And there are some optimistic stories, as I mentioned, like US looks attractive, Latin America looks interesting. So there are areas of the market that, in our opinion, are more resilient. I mean, you're putting tech on the screen, so we like that as well. So there are areas of the market that are resilient, and it's all about kind of ability to pass higher cost, maintain higher margins.
Okay, Maria, we'll unpack more of those calls with you after the break. Maria Weitman from State Street stays with us. Christina Kino, Bloomberg, of course, managing editor. Thank you for walking through some of the key markets. Themes this Friday morning. Coming up, the price of power. Millions of UK households will see their energy bills surge by 54% from today. We get the details and look at what it means for inflation and the Bank of England. Plus, it is Jobs Day. We look ahead to what's expected to be another bumper report. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
I really believe we're underestimating the medium-term impact of this war. We will have consequences, longer-lasting consequences on energy security, food security, I think digital security, payment system security, trade.
Now, the OECD's chief economist, Laurence Boone, there on the impact of Russia's war in Ukraine, and she was very clear, Tom, she was saying that actually they're just not looking at the worst-case scenario, which could be some kind of rationing, which also could plunge us into a recession. We're back with Mrna from State Street. And Maria, we were talking about your ever-optimism on equities, but you were also, cautioning that, of course, we're going to earnings season, so let's see what we get from that. Today, big day, U.S. jobs. Will that make you, depending on what we get, I don't know what the trajectory for the Fed is, but could it make you change what you like in your portfolio?
Definitely, any economic data is very, very important right now, particularly labor market. However, I have to kind of caution a little bit that what we're seeing right now, particularly in labor market, is that incredible volatility of the data. Making predictions is very difficult. The range of estimates on consensus forecast is huge. But for us, the key numbers to look out for would be wages, would be participation. So what we want to see and what we suspect can change kind of market expectation about rate hikes is that are people returning to the workforce, how much people returning to the workforce, and what does it do to wages. If there are lots and lots of people coming back, then potentially maybe the wage pressures maybe not as huge as we kind of previously estimated, and that can potentially change the Fed outlook. And equally, if there are not many people returning and wages are increasing much faster, then potentially we might have more hikes being priced in. So yes, absolutely, very important number. Would be surprised if we get a very kind of solid answers to this uncertainty, though.
Okay, 490 is the survey now for the non-farm payrolls. Maria, when it comes to US versus Europe, you prefer US to Europe at this point. What would change your view on European equities?
European equities, we used to like European equity at the beginning of the year, at the end of last year. So for us, that was kind of reflation trade, better economic growth. So all those kind of stories were really, really exciting. And we hoped for kind of European catch up, but still huge valuation, kind of discount in Europe. Unfortunately, war in Ukraine really upset that trend for us. So it's very difficult to see strong cyclical recovery if Francine was talking about, supply chains are being disruptive, if uncertainty is increasing. So that part is very challenging, and we suspect that's probably not going to be resolved anytime soon. So it's still quite difficult situation with the war. So war is really kind of factors that made us less positive on prospect of European companies.
Maria, what will you be watching out for in terms of earnings? So is it inventories or is it margins? And it was interesting to speak. Mohammed El-Arian was saying, look, the problem with stocks is that it's a difference between absolute and relative terms. So if you don't have anywhere else to put your money, equities are almost going to go up no matter what.
Yes, absolutely. I really like to that point is that, okay, we're worried about economic growth, we're worried about slowdown, but actually Q1 have shown it to us that it had been a challenging year for challenging quarter for stocks, but more so for bonds as well. And if you are an absolute investor, you need to put money somewhere. And stocks, to my mind, look a lot safer than other asset classes. And big point for me is that we still corporate and consumer and in aggregate, and that's actually quite important point that it's an aggregate, still have excess savings from COVID. So balance sheets are strong, and the companies are talking very kind of seriously about very strong buybacks coming up this quarter, this year. So there is money to be spent. So what I'm watching out are kind of two things for me are really important. One is margins, which companies are able to pass higher costs to their consumers. And I suspect there would be quite a bit of a differentiation between companies because, as we said, in aggregate, there is money, but it's actually different type of consumers that have money. So that's the first point. So margins, who is able to pass higher costs. And secondly, capital spending. So we talked about this idea of capex that can happen and needs to happen. And what we beginning to hear from some management is that particularly with war and kind of security situation in Europe, the need for capex is a lot stronger and the urgency to do this capex is a lot higher because we need to shore up the supply chains. We need to ensure the input costs are under control. So capex would be really important to watch out.
And that was a call you were very early on, Maria Weitman, at the early part of this year. I seem to remember you pushing the case to look for capex spending. Thank you, as ever, for your insights, Senior Multi-Asset Strategist at State Street. Just to bring to your attention, the German Bund, there's a sell-off that continues. Yields are higher by 5 basis points on the German 10-year, 6 basis points now on the German 10-year, positive by 61 basis points as markets reprice around inflation. That date of the Eurozone out in the next 10 minutes or so, at 10 a.m. local time, I should say, at 10 a.m. local time. Coming up, defining moment, that's what EU Commission President Ursula von der Leyen said at the virtual EU-China summit today, with China's backing of Russia on the agenda. That story is next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Welcome back to the Open. We are 23 minutes into your European trading day. First trading day of the second quarter. You're seeing gains of 0.4% across the benchmark. Top of your list when it comes to the sectors. Banks up 1.4%. Energy, though, lower by 0.5 on that release of reserves. WTI below $100 a barrel. Of course, that move linked to what is happening in terms of and with the war in Ukraine. President Vladimir Putin says Russia aims to keep supplying gas to European customers. That's even as it pushes them to pay for it in rubles. His statement eased some concerns among buyers. European natural gas futures have, of course, been on a roller coaster ride this week. For more, we are joined by our Europe correspondent, Mrna Tadeo, who is in Budapest, and our senior reporter for international affairs, Mark Champion. Maria, let's start with you then. A lot of pushback from European leaders. You've been speaking to a number of them over Putin's demands for gas payments in rubles. What is the latest on this standoff?
Well, Tom, the back and forth continues, the standoff continues in many ways. Yesterday, Vladimir Putin took many by surprise when he said starting today, April 1st, every company needs to have a bank account in Russia and cash those payments in rubles, and stepped back from it and said, actually, well, Russia's not going to cut supplies. We are a reliable partner, even though some of these countries are now economically unfriendly to Russia. Now, when you look at the response from the European Union, well, it really hasn't changed from the past week. They still say those contracts are in euros. We're going to continue to pay them in euros. The German chancellor yesterday had to put out a tweet to calm everyone down, saying our contracts are in euros is the way it is. It will stay like this, and that is all. When you speak to the Italians, they also say they have trouble understanding the payment system that Vladimir Putin is talking about. They say it would be very difficult to switch the currency in an active contract. And then, of course, you had another warning from a French finance minister, Bruno Le Maire, saying at this point we all have to prepare for this eventuality, a potential cutoff from Russia. This is no longer a reliable partner to the European Union.
Yeah, it's quite a good line. We don't know how to do it. Mark, what do we know about support for the war amongst Russians? I have to say there's been some pretty bizarre stories also about house arrests for certain Putin advisors. I mean, do we really get to the bottom of what is going on there?
Happen in all wars, which is that Russians have sort of rallied around Putin. They rallied around the military, and so there was the most independent pollster in Russia produced a poll that said that support for Putin and for the way he's leading the country is up to 83%. Which is, not far off what it was in 2014 and the boost that he got there with the annexation of Crimea. So, at the moment, support is pretty solid for the war. Have to caveat that by saying that the narrative about the war that is seen by most Russians is extremely different from what's happening on the ground. So, if that begins to penetrate, things could begin to change if Russians don't like what they see. But for the moment, he has the support he needs. About the house arrest, we don't know a lot. There are reports. The U.S. says they have some kind of intelligence saying that Putin has put various of his security advisors under house arrest, and that would presumably simply be because if it's true, they've made such a hash of the
Mark, we're running short of time. I'm sorry to jump in, but we're heading to a hard break. But we appreciate the update as ever. Mark Champion, of course, on Russia and that support. Bloomberg's Mrna today on the ground in Budapest. Stay with us. This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Welcome back to the Open. Happy Friday, 30 minutes into your European trading day, and here are your top stories. Nowhere to hide. Equities kick off April without fanfare after an historically rough first quarter for stock and bond investors. Yields gain across Europe. Russia says it will keep supplying gas to Europe as it demands they shift to payments to rubles. Ukraine-Russia talks are set to resume today. Plus, euro area headline inflation is expected to reach the highest since the inception of the euro today, driven by a spike in energy prices, and it's jobs day over in the US. So we're expecting that Eurozone inflationary data, CPI, to come out around 10 a.m. Then the US non-farm payrolls will be later in the day, of course. The survey is for a print of 490,000, below what we saw in the previous month, but pointing to continued tightness in the labour market, and how the Fed reacts to that, of course, as markets increasingly bet on 50 basis points as the next hike from the Federal Reserve. You're seeing gains of 0.2% across the European benchmark. The DAX over in Germany up 26 points, 0.2% gain there. The FTSE 100 range-bound up just 6 points. In your sectors, you're seeing banks outperforming, up 1.3%. Santander optimistic on the outlook for 2022, continuing to hold to their target for the year. At the bottom of the list, you're seeing technology, consumer products, and energy. WTI below $100 a barrel. The sell-off in treasuries continues in sovereign bonds across Germany. The gilts, the bunds, and US treasuries as well. German bunds currently the yield up 6 basis points on the bund, the 10-year, and the US 10-year currently up close to 8 basis points at 2.41. Francine.
Tom, households in the UK are waking up this morning to a far higher cost to heat their homes. Some of us have hot-footed into Italy. Now, British energy regulator Ofgem has raised the cap on how much consumer prices can increase by 54% from today. Joining us now is Bloomberg's UK economy reporter, Lizzie Burden. Lizzie, I mean, it's a 54% increase. It's huge. And, of course, it's coming in today. Just help us understand how big a deal this will have on, the impact is going to be huge, especially for the households that are struggling the most.
Yeah, well, for those households waking up this morning, the price of boiling the kettle or taking a shower has increased overnight massively. As you say, the price cap's risen 54%, and Ofgem, the energy regulator, says that will affect 22 million households. Combined with the tax rise that's also come in, the Resolution Foundation says it will cost the average household an extra £1,100 a year. And so the Office for Budget Responsibility, the fiscal watchdog, is warning that Britons need to brace for the biggest squeeze in living standards in more than half a century.
Do we have any clarity on the inflationary impacts of this?
Well, the Bank of England is warning that it could mean double-digit inflation this year. And that's because the war in Ukraine is driving up food and energy prices. You've got wholesale gas prices more than 6 times where they were last year. And if you think this is big, the energy price cap, you could see another one in October. Analysts are saying it could be 30%. So all that inflation is driving up, is swallowing wage growth, weighing on consumer confidence, and it raises the risk of a recession in the UK.
So who does it put more pressure on to act? Is it the BOE to hike rates even more, or Treasury to give some kind of fiscal support?
Well, I'd say it's the Treasury, but the chance has slightly been and gone. The Chancellor at his budget last week united think tanks and lobby groups across the political spectrum in their criticism that he didn't do enough to help the poorest households. But even his own MPs are saying that he needs to do more, despite his ambition to balance the books. The problem for the Bank of England is it's already hiked interest rates 3 times back to back. It says there's nothing it can do about the immediate crisis because of the 12 to 18-month lag in monetary policy taking effect. And if it hikes rates any more aggressively, it risks adding to the recession itself.
OK, Bloomberg's UK economy reporter Lizzie Burton on that price cap rising to 54% off GEM and the impacts, of course, in the energy space, particularly households here in the UK. We're going to continue with this story. Joining us now is Dan Monzani, Managing Director of Aurora Energy Research. Dan, your time with the UK government and, of course, your experience now bringing that to the fore and what this means, you think, for households, the ability for households here in the UK to adjust to this increase in the price cap.
Well, it's a very, very steep increase, as you've just said, a 54% increase overnight. And, of course, that reflects the higher wholesale prices that we saw before the invasion of Ukraine because of the disjunction in global markets following the pandemic. So, as you've shown before, those figures could rise again in the autumn as the current forward prices come through into the price cap. It'll obviously particularly affect lower income households who pay a disproportionate proportion of their incomes on energy.
Yeah, Dan, I mean, it's, you know, the impact on some of these households will be absolutely horrific. So I don't know whether it'll spur Treasury to do something. What's also incredible, I mean, I'm sitting in Italy that has a huge dependency on Russian gas and oil. The UK does not have that. I think 3% is what we import from Russia. So, I mean, it's not about weaning ourselves off Russia if you're living in the UK. What is this about? Not being able to adapt? And can renewables really take the baton from here?
Yeah, so I mean, the Chancellor took some small steps in the budget and shortly before that, but nothing of the scale to match the level of increases that are coming on. And there are many people, myself included, who think he will have to act again in order to smooth out this impact. It's a big shock to the economy. It's obviously going to be very hard for households to adapt. It's also going to risk compounding economic problems as those people retrench on spending in other areas or indeed have to borrow money in order to keep going. So there may well need to be more later in the year to support households. You're right to say that we don't use a lot of Russian gas in the UK. 3% is about right over the last year. But we do face a common European price, and that's because, of course, we're very close neighbours. We trade the gas, will go to them if it doesn't come to us. And so when everybody is trying to get hold of the same gas or they're trying to reduce their dependence on Russia, that will push everyone's prices up. There isn't very much we can do about that. We are already supplying about as much North Sea gas as we can produce in each day into the market. But Russia is a globally significant player, and it's hard to replace that volume of gas and that level of uncertainty. So we will face that price, even though we are substantially more physically secure in our supplies of gas than Europe.
Dan, what is the lifespan of our North Sea gas at this point?
Well, it's in decline. The kind of volumes we've got will fall over the coming years. You can expect us to be a much less significant producer in the 2030s. The exact date depends a lot on the economic incentives, because it obviously becomes less economic to extract the very last unit from any any given site. But basically, we're in decline through the 2030s and through the 2020s and into the 2030s.
Dan, when you look at demand destruction, does it happen automatically? We were talking about, for example, if there is an oil embargo coming in from Russia, then we can see rationing in Europe. So governments deciding what companies, can use it or not. What happens in the UK? I mean, if prices go up a lot more, what does it mean for households, how they use energy? What does it mean for how companies can use it? Like, how do you see this playing out? It really is an open question.
Yeah, so demand is relatively inelastic. People don't react very quickly to price. And to give some examples of that, I mean, what we mean by households reducing their energy use can mean sensible, efficient measures like lowering the flow temperatures on their boilers so that they're heating their homes to the same standards, but using their boiler more efficiently. Or it can simply mean turning down the thermostat. And unfortunately, the most responsive groups to price signals like this tend to be people on really low incomes who are having to make terrible choices about whether they eat or heat their homes, and you get a sort of voluntary self-disconnection. So it's not the kind of demand response we really want. Similarly, in businesses, you will see some response, but other businesses simply have to keep the heat going into their operations in order to maintain the integrity of their machinery. I mean, I'm thinking particularly of the ceramics industry, where furnaces have to stay on.
Dan, where does this leave our renewable energy ramp up? Does it derail it temporarily at least, or does it accelerate it?
Well, it ought to accelerate it. So whilst we can't do much about the global price of gas, we can decide how much we use of that gas, how much we do produce our energy in other ways. Now, there are several ways in which we can electrify the economy, and we can use less gas for the production of power. One of which is to build more renewables. The government's also talked about nuclear. There are also measures on the demand side that aren't about making houses colder, but are about heating them with less gas, so heat pumps or insulation. These things will take a few years, but they're things we need to get going with for net zero, as well as to reduce our gas reliance. The challenges on renewables, though, are less about higher targets and bigger ambitions, and more about the plan to get there. So that's both the planning regime. So onshore wind is currently held in its own special category, where it has to be within a local area plan approved by a local authority, rather than approved as a nationally significant infrastructure project like nuclear or another energy source. That could be relaxed in order to accelerate planning and projects that exist. Offshore, the plans probably require greater government or system operator proactive action to build out the network earlier, to build those networks. But on top of that, the government's also going to need to think about how it reforms the markets in order to send the right signals for the complementary technologies that mean we can actually use the wind, because the wind famously doesn't blow all the time. And that's fine in a system where you've got the right market signals and the right technologies like storage, long duration storage, which can move that power from when it's produced to when it's needed, both in time and place.
Okay, Dan Monzani, Managing Director of Aurora Research, also spent 18 years working with the UK government on the question of energy, the need for a more proactive government response there. Thank you for those insights. And coming up, a new wave of COVID infections is highlighting the growing cost of China's zero-tolerance policy. They just reiterated that in the last few minutes. We discuss that next. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Welcome back to the Open. We are 45 minutes into your European trading day. Gains of a little under 0.2% across the benchmark, pairing some of the earlier gains that we saw. In terms of your sectors, personal care, banks and retail at the top of the list, sector by sector. At the bottom, technology down 0.7%. The sell-off in sovereign bonds continues as well. The German 10-year, you're seeing a yield jump there of 6 basis points for the German 10-year. Let's switch focus to what's happening in China. This is an important story, a dramatic story as well, when you look at what's happening in Shanghai in particular. China's COVID zero strategy. It's been drastic, but effective, saving lives and keeping the economy on track. But a new wave of virus cases is highlighting the growing costs of that approach, as well as the perils of any attempt to change it. For more, we're joined by Bloomberg Intelligence Director of Research, Sam Fazeli. Sam, let's start with the binds that China has tied itself in when it comes to vaccinations, when it comes to the low immunity rate, and the healthcare system as well, and the vulnerability. How much of a challenge does this pose China as it looks to a path out of this?
Yeah, I mean, I think they must be sitting there thinking, such bad luck. And it's called Omicron. That is the crux of the problem. If you think about it, all along the way with the other variants that managed to keep it under control, this one transmits so easily, and people can be infectious so quickly after themselves being infected that it's very tough to keep a lid on it. And the other element that's very tough is that a lot of people are asymptomatic, so they don't know they've got it. So currently what they're trying to do is try and keep testing, see if they can find these little pockets of people, including asymptomatics, and keep a lid on it. I don't think they're going to win this one the way they're going.
Just for the context, because I was there up until August, and I came back here, and people were amazed when I said, I don't know anyone who knows anyone who's had COVID in China. That is now changing when I speak to people in Beijing and Shanghai, just to point to the potency of Omicron and the challenges ahead. I know Francine has a question as well. Fran.
Hi, Sam. I show up to Italy and you're showing up in the studio. No comment. When you look at, what it means going forward, if I don't know whether we're going to see some kind of other violent virus that China will have to worry about more, but can you give us an indication of why there's still this COVID zero policy? Is it the number of deaths, or is it just that the health system cannot cope with it? Because this is not a particularly bad, from as far as I understand, virus strain compared to we had at the beginning of the pandemic.
Yes, Francine, I'm afraid that's actually not true if you're unvaccinated. There should be or expected to be a slightly lower relative severity to the disease that Omicron causes if you're not vaccinated. But the problem is the number of people it infects. The absolute result is going to be devastating. So here, I think what they're still hoping is to be able to control it this way. I am seriously in doubt that they'll be able to do that.
What is the role of the mRNA vaccine, and are we any closer to seeing China approving Pfizer and Mrna to effectively combat this spread?
Yeah, so Mrna hasn't, as far as I know, filed in China. I'm pretty sure they're in discussions at some level. BioNTech, with its partner Fosun, have filed, and it's, I would guess, at least 6 months ago. So why it's taking so long, I don't know. But our view, which we wrote in a piece just overnight, is that the best way to deal with this, I think the only way to deal with it, is to do local rapid boosting with an mRNA type or a vaccine as good as, maybe they have some already in China that they made themselves, and then allow the infection to spread. I can't see how else you can do it and not keep this society closed or semi-closed permanently.
And the Centers for Disease Control in China coming out just in the last few minutes saying we are sticking with our COVID zero policy. It is well worth taking a look at Sam Fazeli and our team's piece on this, the conundrum facing Chinese policymakers, such an important deep dive, and the potential paths out of this, all of them with their own challenges. Director of Research at Bloomberg Intelligence, Sam Fazeli, thank you for those insights. Let's get to the first word news now with Laura Wright. Laura.
Thanks, Tom. Ukraine says talks with Russia are set to resume today. That's as the United Nations warns relief convoys have so far failed to reach Mariupol, the port city devastated from weeks of shelling by Moscow's forces. Meanwhile, the International Atomic Energy Agency says Russia has agreed to hand back control of the Chernobyl nuclear plant to Ukraine. Hundreds of protesters have clashed with police outside the private residence of Sri Lanka's president on the outskirts of Colombo. Local TV showed police firing tear gas and water cannons at demonstrators. There's widespread anger in the country over surging living costs and daily power cuts stemming from a foreign exchange crisis. The US has ordered an unprecedented release of its strategic oil reserves in an effort to tame rampant prices. President Biden blamed a spike in gasoline prices on Putin's invasion of Ukraine, but he also criticized US oil companies that have been reluctant to increase production and said he's hoping to see other countries also boost supply. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom Francine.
Laura, thank you. Coming up, concerns over policy mistakes from the Fed. We will hear more from our interview with Mohammed El-Erian next. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
That the market is increasingly concerned that the Fed will make a policy mistake, and the markets are accordingly say, just pay attention.
Okay, pay attention. Do you worry that a 50 basis point hike from the Fed is actually the wrong message because it suggests panic and too many questions about what happens next?
Look, I worry that we're in a no-win situation. I worry that the Fed now has to choose between one of two mistakes and has to decide which one it would rather make.
Okay.
Go too fast or go too slow. I would go too slow. That's a mistake I would make. But I understand that a Fed that has lost credibility may want to go too fast.
Okay, but because what do you worry about? That if they go too fast and they have to reverse it, which is what we've seen in Europe about 10 years ago?
I worry that they'll tip us into recession. That's what I worry about. That they are late, that they mischaracterized inflation for too long, they didn't do enough, and now they feel that to regain their credibility, they have to show, and they hike twice by 50 basis points.
Yeah, Mohammed, Danny also has a couple of questions for you.
Yeah, Mohammed, good morning to you. Thanks so much for joining the program. And you've been very clear of your fears over recession. Earlier this month, you called for the potential of double-digit inflation figures. Does an SPR release from the Biden administration and lower oil prices this morning relieve any of those fears for you?
It helps, but it doesn't remove them. I think that the distribution of outcomes has shifted. Stagflation used to be a risk. It's now a baseline. Goldilocks used to be the right, now has moved to being out completely of the distribution. And in the left tail, recession has come in. I don't think that the release of the oil will significantly change that distribution.
Our interview earlier with Mohamed El-Erian, the chief economic advisor at Allianz, also Bloomberg opinion columnist. It was really interesting, Tom, also speak to Laurence Boone of the OECD, one of the very first interviews that she's given in the last 3-4 weeks, really since, I guess, the acceleration of the war in Ukraine. And she was saying that, look, markets aren't really understanding what could go on. So if you game it and if you see what the worst case scenario is, of course, there's an oil embargo, extremely difficult to model. But if you have some kind of rationing, so suddenly countries having to decide what industries can use gas and oil because they need to save from others, then it could be really messy. And she says, look, markets at the moment haven't really grappled with that.
And that really ties into the comment from El-Erian there on stagflation now being the base case as he illustrates and underscores his concerns about recession. By the way, when it comes to the bond markets, because of course inflation is the factor here, and we're waiting for that Eurozone inflation at around 10 a.m. local time. The sell-off continues, very pronounced in BTPs this morning. Italian 10 years, the yield is up around 9 basis points, Francie.
Yeah, and this is exactly what El-Erian was saying, is that sure, equities are going higher, but it's because it's relative. There is nowhere else where you put money that actually gives you a good return. Later today on Bloomberg TV, we'll also be speaking live to the Ambrosetti chief executive, Valerio De Molli. He has some great research analysis on where inflation ends up. Also, the Dutch central bank governor. That's an exclusive conversation with Klaas Knot, possibly the interview of the day, to try and figure out what it means for ECB tightening. And then the European Commissioner for Financial Markets, Mrna McGuinness, also joins us. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Today, I'm authorizing the release of 1 million barrels per day for the next 6 months.
According to our intelligence, Russian units are not withdrawing, but repositioning.
In order to purchase Russian natural gas, buyers must open ruble accounts in Russian banks.
This is Bloomberg Surveillance, Early Edition, with Francine Lacroix.
Biden's record oil release, the U.S. president's plan to tap strategic reserves, risks undermining his green credentials while crude prices continue lower. Putin's gas ultimatum, the Russian president demands buyers to pay for fuel in rubles or else European gas prices fluctuate. And stay with Bloomberg TV. Today we'll be speaking to a top lineup of guests, from the Ambrosati Forum. We'll be talking to the Dutch Central Bank Governor, Klaas Knot, and the EU Commissioner for Financial Markets, Mrna. Send in your questions on IB Plus TV Go. So good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. This Friday, coming to you from the lakes of course, Como. I'm Francine Lacroix in Cernobbio, Italy, where we focus on the world economy under this conference. Also, Isabel Schnabel, ECB board member, shows up tomorrow to talk about inflation. We have an exclusive conversation on inflation, on possible ECB tightening with a central bank governor. Now, first, though, let's check in on the markets. Our Danny Berger's in London with the very latest. And Danny, we're also getting some breaking news for manufacturing PMI.
That's right. March manufacturing PMI coming in at 56.5. The preliminary was 57, so a little bit weaker there. Reflects also we saw in China a lot of the PMI is missing as well. Concern about the economy. Still strong, but Francine, it's a more positive market to start this first quarter. Oil is declining. WTI below $100 a barrel, down 1% after falling some 7% yesterday. Of course, Biden announcing SBR releases. That giving some solace to the equity market today. Yesterday it didn't. We saw a decline of more than 1.5% for U.S. equities, but today futures market up 0.4%. Now, yesterday also saw the close of the 210s inverted. Now, we are having this conversation of just very brief inversions. When does that last to a more sustained inversion? Well, for now, that fear ebbing as we are just 2 basis points as all yields are moving higher this morning, and the yen also declining for another day. Here's your view in Europe. This is also positive as well. We're looking at gains of 0.2% across most of these regional benchmarks. Even the UK doing well, Francine, despite many of the oil majors living here, up about 0.4%. So as we look at a rebound, is it a bear market trap, Francine, or has the bottom been put in, and is it now safe to buy?
Yeah, the $1 trillion question. Danny Berger, thanks so much. Now, President Biden has been defending his energy plan. He says the plan to release 1 million barrels of oil a day from U.S. reserves over 6 months lays a real foundation for the country to actually achieve independence.
Today, I'm authorizing the release of 1 million barrels per day for the next 6 months, over 180 million barrels for the from the Strategic Petroleum Reserve. This is a wartime bridge to increase oil supply until production ramps up later this year.
Well, here to talk about the latest market moves, Bloomberg's markets editor, Christine Aquino. We'll get to Jeff Yu, of course, from BNY Mellon in just a second. Christine, I have a million questions, first of all, on what the markets are looking at. We spoke to Mohamed El-Erian earlier, and he was saying, look, the problem with the stock market is that it's one of relative value. If bonds don't give you any return, that even if you think that the war is being mispriced, you have to put your money in stocks.
Absolutely, Francine. And I think that's why we've seen a little bit of Tina action in equity markets this week. Of course, there is no alternative, because that is, again, kind of the adage that investors are working off of at the moment. The traditional 60-40 portfolio definitely getting challenged by the bond route, which we know is quite the historic decline in last quarter. And by some measure, it is the biggest decline on record. And so if you're an investor who really can't go to bonds because of those losses, then where else would you want to go, And stocks seem to be the answer at the moment. But again, a lot of uncertainty potentially still not being priced into this market that investors really have to be wary of over the next couple of weeks and months.
So, Jeff, where do you want to be invested in the markets? Are you fully invested in stocks?
I would say it's a combination right now of having diversification. That's still necessary. What we're seeing in our underlying flow monitors, people want stagflation protection, and that means two particular places, actually. Areas where, one, you have high real rates or hiking central banks, Latin America, and secondly, commodity-linked currencies, Aussie, NOK, and even sterling, actually, we're seeing clients buy it because of high mining and energy exposure with the FTSE.
Yeah, it's interesting that you actually pinpoint to a lot of currency moves, because, Christine, this is something that we also spoke to the OECD. You have to forgive me, it's very windy. It's beautiful, but it's very windy in Italy at the moment. So we were speaking to the OECD chief economist, and she was saying, look, one of the things that central banks need to watch out for is, of course, this currency volatility, because it could complicate what they're trying to achieve even more.
Absolutely, Francine. And I know that we've seen a number of central banks already getting a bit more concerned about their currency levels. The Bank of Japan, of course, looking to potentially curb some of the moves in the Japanese yen. We also saw, for instance, the Norges Bank yesterday kind of making a move on their currency as well, because, again, it's kind of, I guess, a different sort of currency war, where while they might not necessarily want excessive strength in their currencies, which is kind of what we're seeing now. And so it's going to be quite an interesting space as well, especially when you factor in the dollar effect and, what the Fed tightening path means, what the potential disruption to commodity flows means. That will have big implications for the dollar and the rest of the G10 and emerging market FX complex.
Yeah, it certainly will. Jeff, what do you worry about the most in the markets? I know, for example, Mohamed El-Erian was pointing to some of the commodity countries that don't have that much solidifying, I guess, stability when it comes to finances. Are we going to see something very ugly in certain types of emerging markets? How do you see this playing out?
Well, right now, not really. It's one of the phenomenons seen since the pandemic. Because of some of the supply chain issues and higher prices, there's actually been quite a bit of a demand destruction. So, traditionally, the current account deficit countries, especially in EM, where you worry about balance of payments crises, they've actually seen surpluses emerge. But I wouldn't call that healthy, because domestic demand has been suppressed so much, and you can only go so far with this. I don't worry about financial risk. One tail risk we actually have been looking at is, and the UN World Food Programme, they've been worried about this as well, ags. So famine, for example, rising in agricultural prices. The war has not helped the situation, and I think this is going to start to move up the agenda as well. Yeah, and this will, Jeff, actually hit Europe the most because of fiscal spending
as I guess we try and help with the refugee crisis coming from Ukraine and elsewhere, but also impacts the Middle East huge because of their dependence, of course, on some of the flour, wheat and grain coming from Ukraine and Russia.
So for the Middle East, that certainly is an issue. Many parts of Africa, that's been highlighted as well. Going back to Europe, the fiscal impulse we are seeing in Europe, that's actually, I think, generating inflows. Again, looking at our custodial flow data, seeing inflows into European equity markets in particular. I think valuations have been attractive for some time. But people are seeing this could be the final fiscal injection on top of NGU, the other programs that we've been waiting for Europe to get reflation happening. So now bets are being put forward for the ECB to move, perhaps on policy guidance even before the June meeting. So one hike this year, two hikes this year, everything's on the table.
Oh, Jeff, thank you so much. As always, Jeff, you there of Senior EMEA Market Strategist at BNY Mellon and our Markets Editor, Christine Aquino. Now, we'll have plenty more, of course, on the markets. We'll talk about U.S. jobs. It's today. Also, the European Banking Authority publishes its Ukraine war risk assessment. So we'll be joined by the EBA Chairman, José Manuel Campa, to discuss the stability of the EU's banking system. That's coming up shortly, and this is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
In order to purchase Russian natural gas, buyers must open ruble accounts in Russian banks. When assets in dollars and euros are frozen, it makes no sense to use these currencies of these countries.
Now, the Russian President Vladimir Putin on why it makes no sense to make him or to him not to demand rubles for Russian gas. Of course, it makes sense to him, but it doesn't make sense to the people that have to do that given the sanctions and the complexities over it. Now, in spite of European leaders rejecting his demands for rubles, Vladimir Putin says Russia aims to keep supplying gas to European customers. His statement eased some concerns amongst buyers. Now, European gas futures had actually jumped earlier this week, but have since pared back some of those gains. So for more, we're joined on this by our European correspondent Mrna today, who's in Budapest. Mrna, to put it very simple, I know leaders hide behind the fact that there are treaties and not treaties, and of course they've signed contracts, but there's a generic idea that actually leaders don't want to make Putin's life easier, given the sanctions and that they're trying to make him back away from the war in Ukraine.
Yes, Francine, and you nailed it. That is the big problem for European countries here. They say, one, they don't want to play into blackmail, but two, if you pay in rubles, essentially you're going against your own sanctions. You put your companies in a position that they will also go against the sanctions that the European Union has approved, and therefore you are essentially shooting yourself by doing this. It's a big problem the governments will tell you they have. At this point, they don't want to do it out of principle, but also it would destroy the whole message we've heard over the past 4 weeks that Russia will have to pay a very heavy price for invading Ukraine. Now, for the time being, however, we did hear from the Russians saying we want to get it in rubles, but it doesn't mean we're going to cut the flows. And the Germans repeating the countries are in euros. That's the way it's going to be. We're not changing. But having said that, Francine, behind the scenes, European officials are starting to work on contingency plans, on a plan B in case the flows get cut off. That is something that they're prepping for.
Maria, thanks so much. I'm Mrna today there in Budapest looking at the energy side of things. We also need to look at the bank side of things. Now, the European Banking Authority does not see Russia's invasion of Ukraine as an immediate threat to the stability of the EU banking system. The regulators concerned about the vulnerabilities created from the long-term fallout of the war. Now, sanctions, supply chain disruptions, cyber risks could all disrupt the European economy. Well, we are absolutely delighted to be joined by the EBA's chairman. He's Jose Manuel Campa. Mr. Campa, thank you for joining us for a very important conversation. Now, you basically, cite some heightened market volatility for banks. Is this a good thing because they can actually take advantage of it, or is it the bad kind of volatility that banks could really struggle with?
Well, good morning. Thank you for having me. First of all, as you said, volatility sometimes can be good for institutions because at the end, with volatility, particularly those involved in trading and market-making activities, they can actually benefit from the movements of markets. But the volatility at this stage that we're more concerned about is the signaling, obviously, enhanced uncertainty on the macro environment given the geopolitical situation. And that uncertainty, depending how it develops over time, it might become higher risk, and that's a concern for the European banks.
So, Chairman Campa, what parts in the financial system are you worried about? I know there's a lot of talk, there's a lot of, calls or chatter about margin calls, for example, having to be put on some of the commodity traders. Is this where the fault line is?
Well, it's certainly, let's start where the risks are not. Direct exposures to Russia by the European banks is small. So in that sense, our concern there is very limited. We estimate there's only 0.3% of total assets that are direct exposures to Russian counterparties. So that's not really a concern. As you mentioned, now in the short term, of course, excess volatility and some of the margin calls that are being derived from that in commodity markets, both in some of the basic commodities, also in food prices and food commodities, it's an area of concern. We have seen margins increasing. So far, I think that the margin calls have been able to be met very properly. But of course, it's not just for banks to do margin calls. It's also non-financial corporates that are involved in some of these markets, and they may be challenges with liquidities, and that's an indirect effect that we're carefully watching.
But, Mr. Camp, when you say challenges with liquidity, I mean, to a point where something systemic could happen, or have banks been, pretty careful with these kinds of lending?
No, clearly not. At this stage, we don't think there's any systemic concerns arising from this. We think markets are working properly, margin calls are being attended by those that are being requested to increase their collaterals, and I think that both banks and non-financial corporates that participate in these markets have sufficient liquidity to be able to accept those calls. So I don't see any area for systemic risk, but nevertheless, we need to remain watchful.
Mr. Campi, you're talking about inflation. Will it lead to banks having losses because households may not be able to repay some of the loans or some of the mortgages? Or, at the margins, can they also benefit from inflation if interest rates rise?
You're absolutely right. Inflation has two sides for banks. If inflation materializes in higher interest rates, and then maybe the likelihood that higher interest rates will rise both from the monetary part but also on the markets, that's good for net interest income of banks. But of course, the overall, it's not just inflation, but the overall macro environment. The macro environment deteriorates, and that results in a difficulty for borrowers on making good on their payments and increases in non-performing loans on banks. That's negative news. That's why we say in our risk assessment that although the direct effects that we see from the crisis are small and manageable, we remain concerned about second-round effects and more macro uncertainty that may end up in a deteriorating macroeconomic outlook that then will affect banks' profitability as well.
Right. So you're not expecting some kind of, big loan losses. And if you were, are there banks, where are the banks most vulnerable? I know the Italian banks have quite a lot of exposure, for example, to Russian commodities. Some of the German banks have also been highlighted.
Yes, if I may highlight, the starting position of the banks is very solid at this stage, both on capital ratios and liquidity ratios. Also, we were already expecting an increase on non-performing loans as the last leg of coming out of the COVID crisis. As we saw some of the measures, particularly the government guarantees and moratoria expiring, we were expecting some non-performing loans to increase, which up until now have not materialized. So on top of that, now we need to add concerns about the new macroeconomic situation and the geopolitical concerns. So as you say, I would say that both those banks that have been more affected by COVID impacts in the countries where COVID was more hit, plus now those that are more affected by Russia, the ones that are more likely to be hit. It depends on business models, but geographies, as you say, southern countries in general more affected by COVID. Also, some of the countries more closer to trade relations with Eastern Europe more affected. Those are the ones that are more likely to have the biggest hit.
Mr. Campo, when you look at how a lot of the banks are dealing with Russia, are they going further, maybe even too much further, against, not against the sanctions, but so they're trying to deal with sanctioned individuals, but they're taking a step further and maybe sanctioning all Russians? Is this a concern? Like, are they going, above and beyond the sanctions?
Well, I think at this stage, banks are very eager to implement the sanctions properly. And these were very, as you know, a very broad range sense of sanctions that were decided very decisively and very quickly. So banks are trying to figure out how to implement them properly on all its areas of relevance. I think that you're absolutely right that as they move in this, they're probably more cautious than not, in the sense that they want to make sure they have swift implementation of the sanctions, and that may end up excluding some of their activities. Also, it's also true that some of banks are decreasing their risk appetite to Russian exposures or Russian-related exposures.
Thank you so much, Jose Manuel Campa, there, the chairman of the European Banking Authority, with clarity explaining the exposure of some of the banks on the back of the publishing, of course, that analysis. Now, we'll have plenty more here from the riverbanks of Lake Como. Coming up, we'll be speaking to the chief executive of Ambrosetti. We'll talk about inflation. We'll also talk about how Italy, this country with huge exposure but also huge links to Russia, is dealing with that. That interview with Valerio De Moglia is coming up shortly. You can also send in your questions on IB Plus TV Go. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy. If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance, early edition of Francine Lacqua here in Cernobbio, Italy, on the riverbanks of Lake Como. Jeff, thank you so much for sticking around. We're back with Jeff Yu, Senior EMEA Market Strategist at BNY Mellon. Jeff, how difficult is it for the ECB right now to set policy? We'll be speaking to the Klasgenoot of Netherlands. And for such a long time, they said, well, they didn't have the inflation problem that we're having in the U.S., but certainly the supply shock changes everything.
I think right now the bigger problem is the inflation expectations problem. You know, for so long, for the last decade, we've been worried about inflation expectations being de-anchored to the downside, things falling too much. Now they risk very sharply de-anchoring to the upside, and this really has hit not just the ECB but global policymakers as well. And if you look at how the yield curve is behaving, then clearly there's going to be a sense that the ECB is going to be a bit behind the curve, especially if inflation continues to behave the way it is. So how do you regain the initiative? How do you bring back that narrative? That's just going to be absolutely essential, not just for markets but for European households.
Jeff, I know we're looking, of course, at the price of oil with that big release of stockpiling from the U.S. and, of course, the U.S. jobs data. What are you expecting from the U.S. policy, and how does that impact Europe?
Actually, if you look at the energy price side of it, those are headline inflation components. Right now, we're looking at the jobs data. If we get a strong enough print in terms of average hourly earnings on the 5 handle, say 5.5 or even close to 6, then real wages in the US, if you compare that to core PC, real wages are really going up. You have a demand push. That's something that the Fed will be looking at much more closely. They're not ruling anything out right now. 50 basis points per meeting for several meetings. I think that's got to be something that the market will be shifting as its core scenario.
Jeff, thanks so much. Jeff Yu, their Senior EMEA Market Strategist at BNY Mellon, joining us from our London studio. Coming up, we'll be speaking to the Chief Executive of Ambrosetti here at the conference where I am to maybe do a bit of game theory on what would happen if there's an oil embargo, whether some of the European countries would have to ration, of course, energy consumption. We're back with Valerio De Mogli. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Biden's record oil release, the U.S. president's plan to tap strategic reserves, risks undermining his green credentials while crude prices continue low. Putin's gas ultimatum, will the Russian president demands buyers to pay for fuel in rubles, or else European gas prices fluctuate. And stay with Bloomberg TV, we have a fantastic lineup of guests from the Ambrosetti Forum here on the riverbanks of Lake Como, including the Dutch Central Bank Governor Klaas Knot and the EU Commissioner for Financial Markets, Mrna. You can send in your questions on IB Plus TV. Going shortly, a conversation with the Chief Executive of Ambrosetti, Valerio De Monti. Now, good morning and welcome to Bloomberg Surveillance Early Edition. Do not be fooled by the beautiful, beautiful background. It is freezing here in Italy. The conversation focused on energy supply, focused on inflation, and of course on what happens with food prices. I'm Francine Lacqua here in Cernobbio, Italy for this year's Ambrosetti Forum. Now, first thing is first, though, let's check in on the markets. Danny Berger is in London with the latest. Danny, what are you seeing?
Francine, it really continues to be all about oil. WTI below $100 a barrel. We're seeing a second day of losses in oil after the SPR release from the Biden administration, saying it officially yesterday. Now, that is enough to lift stocks today, although it did not lift them enough yesterday. A historically bad quarter across the board for assets, save for commodities in Q1. We're looking at S&P 500 futures up 0.4%. Francine, it's also jobs day as well. So we are seeing yields push higher, but the yield curve is steepening now at 2.5 basis points. It was negative at the close of yesterday. And gearing up for that jobs day, there is this buying of dollars, but the worst performing G10 currency, it is the yen. Yen weakening against the dollar by 0.7% as the BOJ continues to buy bonds, and that yield differential weighs on the Japanese yen, Francine.
Danny, thank you so much. Now, President Biden has been defending his energy plan. He says the plan to release 1 million barrels of oil a day from U.S. reserves over 6 months lays a foundation for the country to achieve independence.
Today, I'm authorizing the release of 1 million barrels per day for the next 6 months, over 180 million barrels for the from the Strategic Petroleum Reserve. This is a wartime bridge to increase oil supply until production ramps up later this year.
Well, the OECD says the world is underestimating the impact of the war in Ukraine. This month, the Paris-based organization estimated that the conflict's effects will shave 1 percentage point off global growth this year. Well, the OECD's chief economist, Laurence Boone, told me earlier this morning that the uncertainty deters consumers and investors.
I really believe we're underestimating the medium-term impact of this war. We will have consequences, longer-lasting consequences on energy security, food security, I think digital security, payment system security, trade.
So to talk about all of these uncertainties, I'm now joined by the chief executive of Ambrosetti. He's effectively the organizer of this wonderful conference, Valerio De Molli. Valerio, thank you so much. It's so nice to be back in person. I know a lot of the participants are happy to be back. It's also very nice of you to having turned off the temperature in Italy by about 6 degrees, so we really talk about energy consumption. How worried should we be about inflation and the fact that we don't really know where this energy fight with Russia ends?
First of all, thank you, Francine, to you and your team for being back with us here. Yes, we tuned the weather on the economy, so we are freezing like the economy is freezing as a consequence to the war in Ukraine. And energy is one of the issues, but not the only one. Italy with Germany are the two countries with the highest negative impact. 41% of all the gas imported in Italy is from Russia. And as a matter of fact, Mr. Putin is still getting 1 billion check every day of euros to supply gas and oil to the European countries.
What happens if it stops? If we have an oil embargo, which we've never had, and I know there's various countries saying that they will adjust in this way or the other, but are we going to have a shock that could lead to a recession? Or are we underestimating the impact, the profound impact this could have?
Well, as a leading think tank in Italy and number 4 in Europe, the European House Ambrosetti is dimensioning the impact very severely for Europe. We are much more negative than the OECD forecasts, for instance, and we foresee for Italy only 50% reduction of the previous estimate of growth. Say that 2022 GDP growth was supposed to be up to 4.5%. We now believe will not be much higher than 2%. So, of course, it depends very much on the duration of the conflict and on the further consequences we will have.
Can Europe and can Italy spend its way through this? So there's been huge fiscal support during COVID. We also have now refugees that we take care of with fiscal spending and trying to house them and give them a proper education. What does it mean for the purse strings in countries like Italy?
Well, the supply chains of a number of manufacturing industries are severely affected. Takes the steel manufacturing, 50% of the raw materials, coke, for instance, nickel and others are coming from Ukraine and Russia. Combined, 64% of the corn and of the maize are imported from Russia, Belarus, and Ukraine. And so that's going to affect also the food industry. Fertilizers, 50% of them are coming from Ukraine. So the impacts will be very severe. And also, as you said, on the humanitarian side, 2 million of refugees are hosted by Poland only, and 90,000 in Italy.
I know you don't have to deal with the markets every day, but it is surprising to many that the markets, even if they realize this, still seem to be going up. How does this end in terms of cost of living? If you look at, the possibility of recessions, the possibility of, again, the longer-term deficits, what's the main challenge for Italian politicians right now?
Yes, this is a very good question, and the impact will be very severe on the poorest families, particularly in the southern of Italy, but not only in Italy. That will be all across Europe, and the impacts will be asymmetric, and unfortunately, the poorest classes will be touched the most. In terms of the Italian government, I don't think there will be any change before elections next spring, and we expect that there will be a Draghi continuation, at least up to the next spring.
Valerio, did you do any modeling or gaming about rationing? So if the energy crisis gets a lot worse, will countries and will the Italian government have to choose who can use energy and who can't?
Well, as a matter of fact, we made a plan for the government already, trying to simulate impacts and alternative possibilities. And yes, I think we can sort out the problem in Italy in 1.5 to 3 years' time. So that will not be something resolved overnight, but it's not an incredible problem with no solution. We will have the southern pipeline to Mazara del Vallo from Algeria will be potentiated, and that may even double the size. And that solution only will sort out 1/3 of the problems from Russia, and then the other 2/3 may be resolved with agreements with other African countries as well, different geographies.
Valerio, thank you so much. As always, now that we've frozen Valerio, you can go back into the warmth of the conference. Valerio De Moli, the chief executive of the Ambrosetti European House, of course, the organizer of this conference. Now let's get straight to the Bloomberg First World News. In London is Angel Feliciano. Hi, Angel.
Hi, Francine. Ukraine says talks with Russia are set to resume today. This as the United Nations warns relief convoys have so far failed to reach Mariupol, the port city devastated from weeks of shelling by Moscow forces. Meanwhile, the International Atomic Energy Agency says Russia has agreed to hand back control of the Chernobyl nuclear plant to Ukraine. Shanghai has started the part 2 of its phase lockdown, confining some 16 million people living in the western part of the city to their homes. Phase 2 follows the lifting of the 4-day lockdown in the eastern half of the city, although the restrictions will continue at some buildings where infections were recorded. President Putin has unveiled payment terms for Russian natural gas supplies in the continuing row with European consumer nations. From today, foreign buyers will need to open special ruble and foreign currency accounts with Russia's Gazprom bank to handle payments. A French official says the new mechanism doesn't change payments as mandated in supply deals, which will continue as before. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Danny, Fran.
Thank you so much, Angel. Now, coming up, the price of power. Millions of UK households will see their energy bills surge by 54% from today. We get the details and look at what it means for inflation and the Bank of England. That's coming up next, and this is Bloomberg.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
That the market is increasingly concerned that the Fed will make a policy mistake, and the markets are accordingly say, just pay attention.
Okay, pay attention. Do you worry that a 50 basis point hike from the Fed is actually the wrong message because it suggests panic and too many questions about what happens next?
Look, I worry that we're in a no-win situation. I worry that the Fed now has to choose between one of two mistakes and has to decide which one it would rather make.
Okay.
Go too fast or go too slow. I would go too slow. That's a mistake I would make. But I understand that a Fed that has lost credibility may want to go too fast.
Okay, but because, what do you worry about? That if they go too fast and they have to reverse it, which is what we've seen in Europe about 10 years ago?
I worry that they'll tip us into recession. That's what I worry about. That they are late, that they mischaracterize inflation for too long, they didn't do enough, and now they feel that to regain their credibility, they have to show, and they hike twice by 50 basis points.
Yeah, Mohammed, Danny also has a couple of questions for you.
Yeah, Mohammed, good morning to you. Thanks so much for joining the program. And you've been very clear of your fears over recession. Earlier this month, you called for the potential of double-digit inflation figures. Does an SBR release from the Biden administration and lower oil prices this morning relieve any of those fears for you?
It helps, but it doesn't remove them. I think that the distribution of outcomes has shifted. Stagflation used to be a risk. It's now a baseline. Goldilocks used to be the right, now has moved to being out completely of the distribution. And in the left tail, recession has come in. I don't think that the release of the oil will significantly change that distribution.
Our interview earlier with Mohammed El-Erian, Chief Economic Advisor at Allianz and Bloomberg opinion columnist. Now let's talk a lot more about the energy prices. Households in the UK waking up this morning to a far higher cost to heat their homes. British energy regulator Ofgem has raised the cap on how high consumer prices can increase by 54%. Well, joining us now is Bloomberg's UK economy reporter, Lizzie Burden. So, Lizzie, the price increase that's coming in today, it is a big deal. Who's going to have the most impact on?
Well, the poorest households in Britain, Francine, are going to feel this the most. They wake up today to find that the price of boiling the kettle or taking a shower has gone up massively because, as you say, Ofgem, the energy regulator, has increased its price cap by 54%. It estimates that that'll impact 22 million households. And combined with the tax rise that's coming in today, the Resolution Foundation says that it will cost the average household £1,100 more over the next year. So this is set to be the biggest squeeze in living standards in more than 50 years, according to the fiscal watchdog, the OBR.
So how is this price increase likely to impact inflation, Lizzie?
Well, the Bank of England says that inflation could hit double digits this year. It's largely driven by the war in Ukraine. You've got wholesale gas prices 6 times where they were last year. And that means that the Ofgem price cap could rise again in October this year, some analysts say by 30%. And overall, this rise in inflation is swallowing wage growth, weighing on consumer confidence, and it just raises the risk of a recession in the UK.
So how does this complicate the outlook for the BOE and the Treasury?
Well, Rishi Sunak, the Chancellor, has come under immense criticism since his budget last week for not doing enough to support the poorest households. Even some of his own MPs have said that he's going to need to do more to cushion the blow, despite his ambition to balance the books. For the Bank of England, it has its own headache. It's already raised interest rates 3 times. It says there's nothing it can do about the short-term crisis. But if it hikes more aggressively, it risks adding to the pain for consumers and triggering a recession itself.
Thank you so much, our Bloomberg UK economy reporter, Lizzie Burden. Now let's get straight to the Bloomberg Business Flash with Angel Feliciano. Hi, Angel.
Hi, Francine. The U.S. House has moved forward a key piece of President Biden's drug pricing agenda. Lawmakers voted to limit what patients pay for insulin to $35 a month. Approximately 30 million Americans are living with diabetes. But according to a study, they pay as much as 5 times more for a unit of insulin than people in other high-income countries. GameStop shares surged in late trade after it announced plans for a stock split in the form of a dividend. At its upcoming annual general meeting, the retailer will seek shareholder approval to increase the number of Class A shares to 1 billion from 300 million. It says the split would provide flexibility for future corporate needs. And that's your Bloomberg Business Flash. Francine?
Angel, thanks so much. Now, coming up, a new wave of COVID infections is highlighting the growing cost of China's zero-tolerance policy. We discuss that next. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in Chernobyl, Italy at the Ambrosetti Forum. Now, Euro area headline inflation due in a few minutes from now. The print set to reach the highest since the inception of the euro, primarily driven by, of course, a spike in energy prices. Bloomberg Intelligence actually estimates a 7% figure year over year. Also out today, traders will be closely watching U.S. unemployment figures. Now, let's get straight to COVID. China's COVID zero strategy has been drastic but effective, saving lives and keeping the economy on track. The new wave of virus cases is highlighting the growing costs of the approach as well as the perils of any attempt to change it. So we talk China and COVID with our Sam Fazeli. He's our Bloomberg Intelligence Director of Research. Sam, first of all, I mean, it's getting now tricky, especially because the rest of the world is opening up, that China is sticking to a zero COVID policy. What are they worried about? Is it not enough vaccinations? Is it vaccinations, the Chinese one, that works less than, for example, mRNA?
Hi, Francine. I would say it's probably all of the above. You know, the number of people and the closeness of the tightness of that community, if the virus were to get out of hand, combined with vaccines who are effective, but perhaps not as effective as some of the vaccines that we've been lucky to have in the West, such as the mRNA vaccines. That combination is not a good combination, especially with the variant Omicron, because it's so easy. It easily finds people who are in whom we can basically knock out their immunity and infect. So that is, I think, the biggest problem that they're thinking about.
So, Sam, how does this play out? Is there, again, I know for us here in a lot of countries where most of the people have been vaccinated, this feels like a cold. But actually, you were telling me that Omicron can still be very dangerous. What does the healthcare system in China need to do to try and prevent too many deaths?
Yeah, I mean, Francine, the easiest way, of course, is to keep people apart. But that doesn't work for society. That's not how humans are designed, and our economies are not built like that. So we can't do that. And that is what I think China is still trying to do here. The best way, the easiest way to manage it, which will have a human cost, there is no zero-cost methodology here or system that they can use. The best way would be to have a vaccine, which in the West is the mRNA vaccines at the minute, that give you a significant enough boost that protect you against severe disease, and then see how opening a society or a region goes ahead. Try that and see whether you can manage the run on hospitalization in the hospitals that you would probably get. Yeah. I think that's the only way out.
But Sam, are there any talks between Chinese authorities and the makers of the mRNA to get those vaccines in the country?
Well, so China does have other vaccines that have been developed that could have the same benefit as the mRNA vaccines, but the data that we have today suggests if you take a shot from BioNTech or Mrna, on top of even the CoronaVac they've been using, you get a great boost. And in China, BioNTech has partnered with Fosun to deliver vaccines, and they're filed for approval, I guess, about 6 months ago now. So that's up to the Chinese authorities to get that approved and used. And then, of course, you have to get the doses.
Yeah, Sam, what can you tell us about some of the policies in the UK, much more liberal? I mean, I landed yesterday, of course, in Milan to make my way to the riverbank of Como, and it's a very different approach to how you deal with Omicron here. Masks are required, certainly inside, sometimes even outside. Like, what approach makes more sense? What are we now trying to do in a lot of these countries where the vaccination level is quite strong?
Yeah, Francine, you know that I've always been a fan of these masks, especially if they're good masks. I think that's just such an easy way to reduce the risk of an infection and spread of infections, especially on public transport, etc. So that I don't understand. Taking away free tests, I don't understand. But trying to get back to some level of normal and living with the virus, I do understand. My biggest worry with high levels of infections is the problems with long-term symptoms. That's the biggest worry, and I think that's going to be something to really watch for in the next few months.
In 10 seconds, are we going to need a fourth shot?
I think people over the age of 60, or somebody over the age of 65, 70, I think that's a good idea.
All right, Sam, as always, thank you so much for joining us, the Director of Research at our Bloomberg Intelligence and a real expert in coronavirus and some of these vaccinations, our very own Sam Fazeli. Well, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, K-Lines in New York, or Anna Edwards in London. We'll have some great guests lined up. I'll be back also with Ellen Zentner. We'll talk about, of course, the U.S. jobs data. We'll talk about the oil release and what that means for oil prices. And if you have an oil embargo, we could see it. What does it mean for possible rationing of energy? This is Bloomberg.
estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I actually think one of the things coming out of this crisis is going to be a new equilibrium.
I really believe we're underestimating the medium-term impact of this war.
The market is increasingly concerned that the Fed will make a policy mistake.
The geopolitical situation, the energy situation is very severe.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Friday, April 1st. Our top stories today. It's Jobs Day in the U.S. Economists surveyed by Bloomberg say it was another strong month despite the pandemic and problems in the global supply chain. Ukraine strikes back. Helicopters cross the Russian border and attack a Russian oil facility. Meanwhile, peace talks may resume today by video conference. And natural gas prices in Europe are fluctuating. Traders are trying to assess Russia's decision to demand rubles in return for its energy supplies. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines over in New York. And Kaylee, there's a little more sense of normalcy in these markets, if that is at all possible, given what is going on geopolitically. We are in limbo here on European equity markets as we wait for the jobs report in the United States.
Yeah, just about 3.5 hours to go until we get those numbers, Anna. So the market waiting to see how exactly it's going to start off the second quarter. In Asia, wasn't the best start to the quarter. You did have equities mostly lower. The MSCI Asia Pacific Index was down by about 0.4%. One outperformer within that, though, was China. The CSI 300 actually rising 1.5%, so a bit of an outlier there. That was really a move led by consumer stocks in particular. And then in other asset classes, of course, you're seeing selling pressure in the global bond markets today across countries. It was true in New Zealand, where the two-year yield was up 7.5 basis points at 2.967%. That is the highest for that yield going all the way back to June of 2015. Finally, just wanted to point out, after a couple days of strength, it is back to weakness for the Japanese yen, weaker against the dollar by about 0.7% today, Matt. We are back at that 122.54 level.
All right, getting back in a little bit to normalcy, as Anna says, we're seeing S&P futures up about 0.4%. So after the drops we've seen over the past 3 days, I think, the past 2 days, we're down about 1.5%. The 10-year yield at 2.4134. lower right now, and real yields are getting back up closer to that zero level. You're getting a lot of talk about that today, although it's still down to negative 41 basis points on real yields. NYMEX crude trading just about $100 even, 99.83 a barrel for Texas Intermediate, and Bitcoin off 1.4% to 45,126. So this may be a little bit of a risk-off indicator, and that could have something to do with the European inflation headlines coming in hot.
Yeah, absolutely. Talking about things that are normal and not transitory then anymore, Matt, it seems to be inflation numbers that come in hot and beat estimates. So euro area inflation rate jumping to 7.5%. The estimate was 6.7%. So once again, we find ourselves within an inflation print from the euro area that's coming above estimates. Is the surprise not a surprise because we're quite used to that now? But these estimates, they do take some time, don't they, to reflect the reality. This is what we see on the European equity markets right now, a focus on a little bit of risk appetite. But to your point, Matt, about early warning indicators, not much conviction in this early morning trade, it would seem, here in European markets. A little bit of tentative move to the upside as we wait for data out from the United States later. There's a real focus on what's going on in bond markets as well. We know about the inflation impulse in Europe, and that seems to be something that we're embracing once again on the first trading day of the second quarter of 2022. We are once again seeing selling of fixed income and bond yields on the rise. And I put in the German Bund, but this is the case across the European space right now. Brent crude to complete the picture there. After that big drop we saw in the oil price as a result of the SPR release, how long lasting will that be? We're still down at 104, the handle now on Brent, down another 1/10%. We've been lower than that, though, earlier on in the session through the Asian trading day. This is the natural gas price in Europe, and it's interesting to see that this is dropping today. It's been really volatile, of course, so we shouldn't read too much into one day's moves, but there's a lot to be nervous about here with regards to how exactly European countries are going to pay for energy from Russia, using which currency, how that geopolitics and those demands play out. Also focused on the flow of gas, but we're cautioned by some of our colleagues not to read too much into the daily technical headlines about the way that the gas moves around Europe. We'll get to that story with an expert guest later on. I put in Sodexo. This is a catering and business services business. The stock down by 7.8%. They were forced to revise down expectations as a result of both the war and also the lingering effects of COVID-19 then, Kaylee.
All right, Anna, and we see Russian stocks moving to the upside as well. The ruble trading right around that 82 level. Now, a look at what else we are watching today. Chicago Fed President Charles Evans will be speaking at 9 a.m. New York time. Surely we'll get his remarks on the jobs report. Then on the ECB side, Isabel Schnabel and Klaas Knot will be speaking at an event in Italy. And then on that jobs report, that will be coming at 8:30 a.m. New York time. Economists surveyed by Bloomberg are expecting another strong number on payrolls. The median estimate is that employers added 490,000 jobs in March, while the unemployment rate is expected to fall 0.1% to 3.7%. Mike McKee, Bloomberg International Economics and Policy Correspondent, joining us now for more from Washington. So, Mike, what are you looking for today?
Well, Kaylee, this is going to be more of a trend report than a groundbreaking report. What the Fed and everybody wants to see is whether the trend in strong labor market growth continues. As you mentioned, we have a fairly strong forecast of 490,000 with the unemployment rate dropping to 3.7%. But we did see more jobs than expected the last time. Does that continue? Is the labor market as strong in March as it was in February? But it's the earnings and participation rate that are going to really capture attention today, because the Fed, as it begins tightening, is worried about a wage price spiral. Average hourly earnings expected to be higher on a year-over-year basis last month than they were in February. The participation rate just ticking up. And here's why that's important. If we see the participation rate continue to rise, more people coming into the labor force, that puts less pressure on companies to raise wages. You can see what's happened with leisure and hospitality and with goods manufacturing, factory floor wages. They've gone down. The increase has been smaller, put it that way, each month as more people have come back into the labor force. And that's what we want to see today, is the labor force still attracting people to come off the sidelines and ease some wage pressure.
I wonder what we expect from the Fed, considering all of that. I mean, I know everyone now is betting on 50 basis point hikes. Is that, consistent throughout the rest of the year, or are we talking about just 1 or 2 50 basis point hikes?
Well, that'll kind of depend on the data, Matt. If we have several months worth of strong labor market data, it's probably going to push the Fed to do more 50s. they've pretty much locked in the idea of 50 in the market's mind, and they'll want to ratify that in May if the numbers don't surprise significantly, and there's no reason to think that they would. We will hear from Charlie Evans shortly afterwards. It'll be interesting to see his take on it, but probably what you'll hear from the Fed is that the labor market is strong, and we are on the same path we were before the report came out.
Mike, thanks very much. Bloomberg's Mike McKee with us. The focus on the labour market then as we go through the day. Staying in Washington, today's jobs report comes as President Biden faces his party's biggest headwind, persistent high inflation. Biden made a big bet on lower gas prices. He's ordered an unprecedented release of oil from the U.S. strategic reserves. Emily Wilkins, Bloomberg government reporter, joins us now. Emily, what may happen if Biden's strategy works, or tell us what happens if it fails? I mean, this is coming ahead of a key political test for the administration.
Absolutely. I mean, the Biden administration is under immense pressure right now to find a way to lower gas prices, something that's really only partly in their control, but Americans still very much blame the president for. And look, that midterm that's coming in 8 months, generally, historically, midterms are always worse for the party that's in power. So this was never going to be easy for the Democrats, but it gets worse the worse a president's ratings are. Biden's approval rating is at a low of 42% right now. And even though the administration has been trying to push this narrative that these higher gas prices, you know, that you need to blame Putin, that you need to blame big oil companies, voters aren't buying it. According to a Quinnipiac poll that was released, more people blame Biden for these high gas prices than, say, Russia or big oil. So this is really an area where Biden needs to reverse course, or his party could face even bigger losses than expected in the midterms.
Yeah, the most visible sign of inflation when you literally see the price pasted at the gas pump. Thank you so much to Emily Wilkins of Bloomberg Government in Washington. And don't forget to tune in later today, our Jobs Day coverage with Marty Walsh, U.S. Labor Secretary, among others. Now let's get to the latest on the war in Ukraine. Russia said 2 Ukrainian military helicopters made a rare strike across the border. Virtual talks between the two sides will resume today. Meanwhile, the EU is warning President Xi Jinping of China that it will hurt its global role by helping Russia. Let's get more on the EU-China summit with Maria Tadeo, our European correspondent who joins us from Budapest. All right, Maria, what do we know about what these two sides are saying to each other?
Well, Kaylee, what we know is that this call is still ongoing and will probably go on for a couple hours still. Now, the message that the European Union wants to give China today is that it has a big role in this world, it has a big economy, and therefore should use that influence to bring Vladimir Putin from the brink and put an end to this war, that China should in some ways use that influence to end this conflict. Now, the other thing, of course, is that if that's not the case, then the European Union wants to warn the Chinese that there could be repercussions. If you help actively or passively, that could lead to potential sanctions. They don't specify what kind of sanctions it would be. They say this is strategic ambiguity, but that is a warning very similar to that of the United States. And then the third thing to watch out for is the EU-China trade deal. Remember, in 2020, Angela Merkel signed a trade deal with the Chinese, then it failed to be ratified, and it's been put in the freezer for 2 years. For many, this is now dead, especially because we've seen a lot of tensions between the Chinese and the Europeans over state aid, and it's going to be impossible to resuscitate. But that is the other big question going into this meeting that, of course, has focused majorly on Ukraine.
I wonder about the pushback we're getting from European leaders about paying Vladimir Putin for gas in rubles. Putin said, you know, if they don't agree to his new terms by today, he's going to cut them off. Are we going to start to see, you know, European leaders try and nuance workarounds, like say they're paying in euros even though they're using Putin's bank and exchange rate to actually pay in rubles?
Well, that's what they're doing for the time being in many ways. You pay in euros, and then, of course, it's up to Gazprom and its financial branch to decide whether or not it wants to convert it into local currency. But what European officials say is that they're not going to divert from anything that is a direct payment from those contracts into Russia and change it, swap it, and not pay in euros. We heard yesterday from the Germans, we heard from the Italians, also the Italians, and in particular Mario Draghi. He said he was very confused about the payment system that Vladimir Putin spoke and told him and explained to him for an hour. Mario Draghi says that it's very difficult to change a contract while it's active. And then, of course, the French, however, saying we have to prepare for everything. He could cut the flows. That is potentially an option and a possibility, and we need to come up with a plan B. What's the plan B? We still don't know. The one thing I would say, Matt, I'm in Budapest, and here you can watch Russian TV. Remember, the satellite signal was supposed to come down, but here in Budapest, it's not a problem. And I was watching Russian TV yesterday. They played this video of Vladimir Putin saying this is Russian gas, so therefore they should pay in Russian currency. And the star presenter lashed at Olaf Scholz, saying, I've never seen a chancellor like this. He's going to take Germany into financial and economic collapse. So that is the way the Russians look at this, and they interpret this when they watch the news. Of course, very different to how we look at it in the rest of Europe.
Maria, thanks very much. Maria Tadeo, our European correspondent in Budapest, as she mentioned. The reason she's there, of course, is she's monitoring Hungary's elections, which take place this weekend. The Premier, Viktor Orban, is tipped to win a fourth consecutive term. That vote happens on Sunday. Now, stocks wrapped up their first quarterly loss in 2 years, while Treasuries saw their worst quarter in at least 5 decades. Let's get more with Bloomberg's Danny Berger. Danny, the events we've seen in markets are kind of historic, I suppose, in the first quarter, but really because of the confluence of bad performance we've seen across so many asset classes, except for commodities.
Exactly. It was a historically bad quarter, one for the record books, though one probably investors wish that they can forget. So the scores on the door, 5% declines for both stocks and high yield, 5.5% for treasuries, nearly 8% for investment grade debt. So if you put all those 4 asset classes together, you get the worst quarterly performance since 1980. And to your point, Anna, there wasn't anywhere to hide out unless commodities, which skyrocketed higher. But of course, they've been extremely volatile, and just their move higher was part of the reason we saw this big dent across asset classes, because of the pressures from war, because of the specter of higher interest rates. So what does this mean going forward? Are any rallies from here? Are they just a bear market trap, or is the bottom in, and can we outperform for here? Now, trying to predict the end of the year is always a very difficult and perhaps a fool's task, especially now with so many uncertainties. But we still do have an analyst average of 4,900 thereabouts for the S&P 500. That's a gain of about 8% from where we are. But we are starting to see some warning signs creep into analyst estimates. The average change of a year-end target from the start of the year is down about 1.5%. So even though it's just small at this moment, Kaylee, we are starting to see hints of bearishness creep into strategist updates.
It always seems, Danny, that strategists are playing a constant game of catch-up, either to the upside or the downside. Thank you so much to Bloomberg's Danny Berger. Now let's take a look at some stocks moving in pre-market trading here in the U.S. I want to begin with GameStop, the big outperformer before the bell, up 15% after the company said it's going to ask for approval from its shareholders to split its stock in the form of a dividend. This seems like it's becoming a pattern. You have Alphabet, Amazon, Tesla, all announcing similar hopes in the recent weeks. So GameStop is reaping the benefit of that today. Another stock moving to the upside is Robinhood. Apparently, it's getting ready to launch retirement accounts on its app. That news broken by Bloomberg late yesterday. That stock is up about 3%. Sinking lower, though, Blend Labs. This is a software company missed on first quarter and full year revenue estimates. A couple of analysts cutting their price targets on the stock as a result. It's trading at $4.30 this morning, down about 25% before the bell, Anna.
Coming up on the program then, Kaylee, live from the Ambrosetti Forum in Cernovio, Italy, we will be speaking to Morgan Stanley's chief U.S. economist, Ellen Zentner. Francine Lacroix will be bringing us that conversation a little bit later, in fact, very shortly on this program. A lot to focus on ahead of the jobs report. We'll also be talking to Biraj Bhaukataria, RBC co-head of European Energy Research. We can ask him all the things we do not understand about the way that the European gas market is operating right now and what Russian demands really mean. A new wave of COVID infections is highlighting the growing cost of China's zero-tolerance policy. You can read all about that in today's Big Take story. Check out NI Big Take on the Bloomberg terminal. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
The jobs report last month beat estimates.
We have a very tight labor market. It is pretty clear.
Historic recovery in our labor market.
One of the best labor markets in a generation.
Today, Tom, John, Lisa, and Mike will bring you the data and analysis as the numbers cross the Bloomberg.
More people are coming into the labor force. It's going to decelerate the wage gains. Is that good?
As the Fed looks to contain inflation, and it's really important that the jobs recovery continues.
The March jobs report, today on Bloomberg Television and Radio.
I worry that the Fed now has to choose between one of two mistakes and has to decide which one it would rather make.
Okay.
Go too fast or go too slow. I would go too slow. That's a mistake I would make. But I understand that a Fed that has lost credibility may want to go too fast. I worry that they'll tip us into recession. That's what I worry about. That they are late, that they mischaracterized inflation for too long, they didn't do enough, and now they feel that to regain their credibility, they have to show, and they hike twice by 50 basis points.
Bloomberg's Francine Lacqua speaking with Mohamed Al-Arian, Bloomberg opinion columnist, earlier at the Ambrosetti Forum in Cernovia, Italy. Now, for more on this event, Francine is there with top U.S. economist at Morgan Stanley, Ellen Zentner. Francine?
Yeah, thank you so much, Kaylee. I could not be more happy to meet Ellen Zentner right here in the riverbanks of Lake Como. It's beautiful, but very cold. Ellen, the conversations, though, are really about a possible freezing of energy, the impact this has on inflation, and, of course, what the U.S. Fed does. So thank you so much for joining us. Yeah. Is a 50 basis points hike from the Fed problematic in terms of communication, in terms of giving a message to markets that there's a panic, and would they have to reverse it if inflation then cools off?
So I think there's a good deal more financial conditions tightening that we can withstand in the U.S. The Fed's basic problem is that they need to create slack in order to bring inflation down. So I think we're already seeing in market pricing that they're fairly comfortable with the idea that the Fed could go 50. Now, with a Fed that doesn't provide a lot of forward guidance, really that does not provide forward guidance, has to know that when you go 50 basis points, you do open the door for more 50s delivered after that. But I think they're comfortable with the message that we are going to be aggressive. It's just going to be a lot of volatility this year because we don't know when and by how much they're going to raise rates at each meeting.
So does it make sense to front load, though? So could you see a 250 basis point hikes and then wait and see for a couple of maybe months?
Yeah, so our expectation is they do front load 50s. So at the May meeting and at the June meeting. And then they move into sort of this comfortable 25 basis points each meeting. But it could go well beyond that. I mean, you do want to hike while inflation is highest. It is about credibility, and Chair Powell wants to maintain it. He's the first chair since the 1970s to fight to bring inflation down rather than take inflation up. And he is willing to make a policy mistake if that's what's needed, because he's confident he could be nimble to course correct if needed in 2023.
Ellen, given the possible oil embargo, the repercussions, I know Europe suffers first, but then this kind of feeds back into the U.S., the second and third round effects of freezing out Russia. When you look at what the Fed policy is, what does it mean for King Dollar?
So the dollar is going to stay stronger here. I mean, you've got central banks, developed market central banks, that are all reducing the balance sheet, moving more hawkishly, at least in communication, if not already in policy moves. And someone's going to be dissatisfied with their plans. And most likely it's not going to be the Fed. I think the Fed is sitting on an economy that's in the best position to absorb higher interest rates. And I do think since Russia-Ukraine impacted Europe much more disproportionately than the U.S., I don't see how that doesn't result in a stronger dollar, weaker euro.
On the U.S. economy, Ellen, obviously that is one that is powered by the American consumer. And when you look at the spending data of yesterday, adjusted for inflation, a larger than expected drop-off in February. Are we starting to see the first signs of demand destruction due to higher prices?
Yeah, I think it's a great question, because even back in November, we saw consumer surveys show that the concern over inflation rose much higher than the concern over COVID. It is especially painful in the U.S. for lower-income households. They're not just dealing with higher energy prices and higher food prices, but higher rental prices as well. And so what we're seeing is that the consumer is getting much weaker at the lower income levels, but holding up quite well at the upper income levels. And that means that you do need a much more targeted response to help alleviate that burden, targeted toward the lower income households.
Do you expect those inflation pressures to drive more people back into the labor market? And how does that filter through to your expectations for today's jobs report?
So I think that higher inflation will certainly keep wage bargaining alive. I mean, there's every evidence historically that it's higher prices that lead to higher wages, because you go and you demand higher wages. And we've already seen the pressures just from a lack of labor supply. So I think wage pressures remain. I do think that the Fed is wanting to battle aggressively against inflation, because if you don't bring inflation down, then wages will not outpace inflation, no matter how high they are, and that creates a weaker demand backdrop. I think in the labor market report today, we're going to continue to see wage pressures that are there. I think a pickup in labor force participation, and we're expecting about 550,000 jobs created over the month. It's been an incredibly robust, stable pace of job gains each month, and that alone still supports the economic backdrop for demand in the U.S.
Ellen, concretely, what do does the release of the oil stockpiles, is it a political message, or does it actually make a difference to inflationary pressures?
So I think the desire, of course, is for it to make a difference. But I think that because oil prices are globally determined, I don't think it's going to have that big of a sustained impact on getting prices lower, at least more notably for households in the U.S. It is certainly a political message as well, though, because it is number one on the president's agenda, getting inflation down. High inflation can be a campaign killer, and here we are in midterm elections. And so you need to get inflation lower, but there's only so much that the administration can do directly, more than just jawboning around it.
So what does that mean for fiscal policy in the U.S.?
So fiscal policy for the U.S., I think that part of the campaign message will be whatever they can do in order to get inflation down. I think the Fed has heard that message as well. It happens to also be a strong desire of Fed policymakers in order to get inflation down. But inflation will be written all over this election.
Absolutely. Thank you so much to Ellen Zentner of Morgan Stanley and Bloomberg's Francine Lacqua in Cernobbio, Italy. And of course, on the subject of inflation, I think it's the wage data, maybe perhaps, Matt, that the market is going to react to most today.
Yeah, absolutely. Looking out for Mike McKee earlier was talking about the price wage spiral. That's the concern. Coming up, Daniel Morris, Chief Market Strategist at BNP Paribas Asset Management. This is Bloomberg.
that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Economists surveyed by Bloomberg expect another strong U.S. jobs report today. The median estimate is that employers added 490,000 jobs in the month of March. The unemployment rate's expected to fall 0.1% to 3.7%. Ukraine says direct talks with Russia are set to resume today. These negotiations will be by video link instead of the face-to-face setting. Meanwhile, Russia says that Ukrainian forces made a rare strike across the Russian border. 2 helicopters hit a Russian oil tank facility. And natural gas prices in Europe are fluctuating and really in focus. Traders are trying to assess Russia's decision to demand rubles in return for its gas. Foreign buyers will need to open special ruble and foreign currency accounts with a Russian bank. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. And Matt, we're all trying to get our heads around what it is the Russians are asking for and what the Europeans are saying that they will do in response to those requests for how exactly Russian assets are paid for. We've got a great guest to talk about that later on. So what is coming up for you then? What do you see ahead of the US Open?
Well, I'm watching stocks that are rising, or futures that are rising ahead of the US Open right now. S&P futures up now about 0.5%, and investors are selling off bonds, allowing the yield to float up to over 240 right now, 2.4005. Crude is also on the rise, just slightly above $100 for Texas Intermediate, $100.90 a barrel, so it's a gain of just over 0.5%. And Bitcoin is actually down right now, but still holding above 45,000 at 45,253. So in terms of U.S. markets, things look relatively stable. Kaylee, what do you see in terms of the pre-market movers?
Well, I'm actually paying attention to a breaking news headline that just crossed. China is weighing giving the U.S. full access to audits of most firms. Remember, this has been a big issue in recent weeks. The U.S. mandating that you get audits of some of these Chinese companies in order for them to stay listed on U.S. exchanges. So maybe this is a little bit of progress in that direction after some hesitant remarks we heard from SEC Chairman Gary Gensler earlier this week. And as a result, you are seeing a lift for some ADRs of Chinese tech companies that are listed here. Alibaba up 4.27 or roughly 4%. Baidu is up by about 4.7%. So maybe a little bit of relief coming into those baskets of stocks. Also moving higher today, Robinhood. It's looking getting near to adding retirement accounts to its app. It's up about 3%. And I wanted to check on the shares of Apple as well. 2 days of losses in the last 2 trading sessions, but that was after an 11-day winning streak. The stock is back moving higher today, up about 0.4% before the bell, Anna.
Yeah, Kayleigh, those lines then coming out of China, really interesting. Interesting to get the SEC's take on just how substantial a commitment that turns out to be. We'll look for the detail there. This is the European picture then. European equity markets, to Matt's point about stability, waiting for the jobs report later on today. We've got a bit of stability here in the European equity session, up by 0.6% as we wait for that key data to hit. We had inflation data out for the Eurozone earlier, which came in well above the estimates. We've kind of got used to that being the trend. We certainly got used to seeing high inflation prints, and the bond markets continue to look ahead to a higher yield environment, and we've seen this across the European space on the first trading day of the new quarter, of course, this being April the 1st. I put in here German bunds, but we could have put in all kinds of different debt products across Europe because we are seeing a continuation of that sell-off in fixed income and yields moving higher. This is the natural gas price. This is really in focus because of the complexity of what we're hearing about the way the gas flows across Europe from Russia to Europe, or perhaps on occasion back again, and also what we're hearing about the Russian demands for payments in rubles. We'll get a guest on very shortly to explain a lot of the detail to us, but for the moment we're seeing a little bit of a move lower actually in that particular price. This is the Russian market for you. The stock market is up by 2.8%. Another day of gains, the third in a row I think for Russian stocks. It seems that the Russian investors very much focused on the talks that are set to take place between Russia and Ukraine then, Matt, and what that could deliver. Of course, international investors maybe have modest expectations, but certainly that seems to be a talking point in Moscow.
Wow, a dollar buys 82 rubles. I wonder who's actually paying that rate, although maybe Europeans are. I'm looking at the discount that European stocks trade to U.S. stocks in a forward PE basis. The discount is now 35%. So the question is that too cheap to ignore? Do you go in and buy European stocks? Or are you concerned about the Russian gas pricing issue? And I mean, look, Anna, people in the UK are facing now energy bills that are going to jump by 50% overnight. That can't be good for stocks. Joining us now is Daniel Morris, Chief Market Strategist at BNP Paribas Asset Management. Dan, what are the risks here that these higher energy prices, or even the possibility of a cutoff, present?
Well, multiple risks potentially. If you think about, generally speaking, the better tone we've had for European equities recently, you imagine that's premised on two things. So one, that the conflict doesn't expand beyond the borders of Ukraine, which of course at one point was something we did worry about, and that the energy supplies keep flowing. Now, particularly the second one we appreciate is volatile along with prices, and that could change. But generally speaking, I think the markets are assuming that that happens. So as long as the gas and the oil continues to flow to Europe, the economy should be able to weather it. Nonetheless, we do appreciate that almost with any of the scenarios we might imagine for the conflict, prices are going to stay high, inflation is going to stay high. And I think that highlights kind of the next risk that we may see, which is that we start to perceive that the ECB is behind the curve in the same way that we realize that the Fed is. And so are we going to have to start adjusting to higher rate expectations for the Eurozone? And we saw in the first quarter of this year what that can do to equity markets when we had the decline in the S&P.
Is this a market, Daniel, that is pricing in a substantial slowdown for the European economy, but not a recession? Even those who are pretty pessimistic on the way that Europe performs this year, reluctant to talk about outright recession at this point?
Well, I think it's not only reluctance, but we really are quite a long ways away from a recession. If you look at what happened back in 2010, 2011, you actually had a similar increase in oil prices from about $70 per barrel to 110, 120, and it stayed there for 3 years, which is quite different from, just a spike that comes back down. Now, back then, you actually did get a recession, but I think you'd argue that was much more because of the Eurozone crisis. And the key difference is back then, the annual rate of growth was about 2% per year for the Eurozone. Now we're about 4 coming into this. So even if we are getting those negative revisions to the outlook for growth, you're going from 4% to 3.3 and still 2.5 next year, which for the Eurozone is very high. If you look at the average growth rate for the Eurozone since 1995, it's 0.4%. So we're, I think, a long ways from a recession now. We do have a buffer, and I think that's what the important focus should be.
Daniel, in terms of the sectors you want exposure to, then maybe staying in Europe, but perhaps expanding over to the United States as well. Is it all about commodities? Looking back at Q1, commodities seem to be one of the few asset classes that had a relatively strong period. That doesn't necessarily bode well for the rest of the economy, but in terms of places to hide out from the inflation.
Well, on one hand, if we just think about kind of what parts of equity markets perform comparatively well when you have rates rising, you're exactly right. It is the commodity sectors that are the most resilient. I think the other sectors you can look at actually are small cap stocks in the U.S. historically have done well when the Fed is raising rates. So I think it's at least another area to consider. Though, to be honest, the markets that do the best when the U.S. is raising rates are non-U.S. markets. I mean, it's not to suggest that rising rates is a good environment for equities. It's not. Now, equities don't have to fall. We don't think they will. But it is going to be a struggle, and it is really trying to find the best parts of a market that's going to be more challenged.
Well, Daniel, rates aren't rising everywhere. Yes, you have the Fed, the BOE, maybe the ECB making moves in that direction this year, but in Asia, the BOJ, the PBOC, they are moving in the opposite direction or not moving at all. What kind of opportunity does that create?
Well, I think that sets up well. You know, you were previously discussing about the discount of European stocks to the U.S., which may be an opportunity. We're looking, instead of maybe playing that particular trade where, again, in both markets, rates essentially are going to be rising, and thinking that you're going to find better opportunity in markets where, number one, you do have good earnings growth. And even though we don't think about Japan as a strong earnings growth market, at least for this year, it is quite good. China also rebounding from what had been a quite disappointing year last year. So you have the earnings growth, you know, like you have in the U.S. But as you suggest, the key difference is a completely different monetary policy environment, you know, probably steady or very modestly higher rates in Japan, probably lower rates in the future in China. And that's a huge contrast to certainly what's coming in the U.S. and what we think is going to be coming as well in the Eurozone.
All right, so we've talked about different regions and different sectors within equities where you want to put your money. What about different asset classes' performances to one another? Will stocks continue to outperform bonds, or do you anticipate we'll get a point where bonds actually become attractive because yields are so high?
Well, I think it was, again, kind of unusual. What we saw at the beginning of the year was the underperformance of equities versus bonds. But broadly speaking, in rising rate environment with the Fed hiking, equities do outperform. So lower returns in absolute lower returns in absolute figures for equities compared to your long-run average, but still better than bonds. So broadly speaking, we would expect that pattern to continue. So still equities better than bonds. Again, these sectors that are more positively sensitive to inflation, like commodities and potentially small caps, in addition to other assets, you know, you want to think about, of course, inflation-linked bonds for protection over the longer term. So it is a question of trying to find those parts of the portfolio that are going to be the most resistant.
Daniel, thanks so much. Daniel Morris of BNP Paribas Asset Management. Whilst we were just talking about the markets there with Daniel, some lines dropping from Gazprom, the Russian supplier, of course. It says it is notifying clients of new payment rules Friday, assume that means today. Payments for exported gas are to be in line with Russian law, according to Gazprom, but they do go on to say that they responsibly continue to export gas to clients. Not much reaction in the European benchmark gas price right now. Why not? We'll talk to Biraj Borkhataria, who joins us shortly, RBC, co-head of European Energy Research. Great guest, great perspective to bring you at this point. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Now, natural gas prices in Europe have been fluctuating over recent days as traders assess Russia's decision to shift payment for its gas supplies to rubles. Joining us now to help us understand all of the complexities here, Biraj Borkhataria, who's RBC Head of European Energy Research. Biraj, really nice to have you with us. So help us understand a little bit about this. So Gazprom says that this is all under, these are Russian contracts, I think they were talking about, with gas exported under Russian law. Can you help us understand what jurisdiction these contracts are under, what currency is mentioned there, and how much that matters? You know, at the end of the day, will it be contract law that decides this, or military might?
Yeah, it's actually very confusing because the message you're getting from both Putin, Draghi, and other German ministers is conflicting. So the contracts as they stand today denote a specific currency, which is euros, and amendments to those contracts would require agreement on both parties. So it's not entirely clear whether you could pay in euros to Gazprom Bank, and then the conversions and the currency switching could be done there. But at this point, the headlines seem to be fast and furious, and it's difficult to know where we stand.
I wonder if military might is even necessary for Russia to moot jurisdiction. We heard from the CEO of BASF today saying that the German economy would collapse, that it would be catastrophic and the worst recession since the Second World War for the country if gas was cut off. Do Europeans have any choice but to agree to Russian gas demands?
In a scenario where the flow of gas is cut off for contractual or other reasons, at that point, it's very significant, right? It's 30 to 40% of European gas needs. The governments and the regulators would have to step in and ultimately ration that gas and decide which industries are critical, which sources of demand are less critical, and ultimately do their best to try and protect the residential consumer as well.
Biraj, we're just getting some headlines out of the Kremlin. Spokesman Dmitry Peskov is speaking on a conference call. He says that gas will continue to flow while ruble payments are pending, and that ruble payments for April gas is due in late April and early May. So we continue to get the incremental updates on this from the Kremlin. Can we talk about where there's capacity elsewhere? Should anything go awry? Should supply get cut off? Of course, this is all hypothetical. Is there excess capacity in other places to come from? The U.S., for example, making that pledge on LNG. How far can that realistically go?
So it's important to highlight that the gas market was already extremely tight heading into all of this. And so if you could produce, you were making very significant profit margins. So Qatar was already exporting ahead of capacity. The U.S. was already growing. The incremental 15 BCM of U.S. exported to Europe, we calculate around 20 BCM of additional capacity into 2022. And most of that is already coming to Europe anyway. So with LNG, the price determines where the gas goes, whether it's Europe or Asia or South America, and not necessarily a letter from the White House. So we think that headline from the White House is basically non-news. The gas is already flowing to Europe because TTF is trading at a premium to JKM.
Is there the possibility of turning on alternative sources, Biraj? I mean, the Germans infamously have millions of tons of lignite coal, and also they've turned off all of their nuclear reactors, or most of them. So is it possible to get those things back up and running, or would it just take too long or be politically impossible?
So on the nuclear front, our understanding is those 3 nuclear reactors will be shut down at the end of this year. You are likely to see companies running coal assets harder, as hard as they can. You'll need a variety of measures in order to stave off Russian gas, but I can't understate how significant it is when it's 30% of your gas needs. You can't replace that overnight by LNG or otherwise.
You can't replace it, but you might need to step in to manage people's use of it, might you, Biraj? Are we heading in that direction in Germany or elsewhere? We saw the Germans enacting the first of a 3-part plan to, in the first stages, just monitor gas usage across the country in a kind of intensive way, but the suggestion being that later on there could be further involvement to try and make sure that stocks last as best as they possibly can. Are we looking at some kind of rationing as we go into the winter?
So it really depends on the flow of storage through the summer. So we expect summer pricing for European gas to be extremely strong because you need to incentivize more gas to go into storage. I think there'll be 2 prongs of how you ration gas. The first one is purely economics. So if you're a consumer in the UK, for example, as of today, your electricity and gas bill has gone up 50%. That might cause you to think about your usage, and that could see some demand destruction there. You'll have the same thought process from an industry standpoint. You might see refineries and chemicals facilities and so on maybe run at low utilizations because of the power prices just so high, which is obviously driven off gas. And then in a worst case scenario, yes, you'll have the regulators and the government have to step in and ultimately ration the gas if there's not enough to go around.
Yeah, how long before we get European leaders asking Europeans, and I mean that in the broadest sense, to consume less energy as a sort of patriotic act at a time where parts of Europe are at war? Biraj, thank you very much for your thoughts. Good to speak to you. Biraj Bokataria, RBC Head of European Energy Research. Coming up on this program, we'll get the US perspective on energy and with Senior Advisor for Energy Security at the US State Department, Amos Hochstein. That conversation at 8 a.m. in New York, 1 p.m. in London. So a little bit later today. This is Bloomberg.
And behind me, you can see SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance, the early edition. I'm Matt Miller with Kaylee Lyons in New York, Anna Edwards in London. Tom Keene joins us now, co-anchor of Bloomberg Surveillance, the original. Tom, what's your single best chart for this Jobs Friday?
Well, it's about what everybody's focused on, which is wages. And you have that, Matt. It's extraordinary in America what 7% and 5% inflation will do. And the chart is really stunning. It is 20 years back, make it 25 years back, and it shows real wage growth. This is the integrand. In mathematics, it's the area under the zero line. And long ago and far away in 2011, there was a real dearth of wage growth in the middle of the chart. And over where we are now, we've greatly exceeded that. The persistency of a diminished wage growth is truly at a record level for 25 years.
So that's the wage focus, and you've got a great lineup of guests then to digest the data that's breaking today on the wages front and all the other dynamics that are within the jobs report.
And many of our usual guests, Anna, and we are thrilled to bring you one of the great thinkers in modern Wall Street. Dominic Constant will join us from Mizuho Americas, along with the usual visit from the former governor of the Fed, Randall Krosner, Booth School, Chicago.
All right, Tom Keene of Bloomberg Surveillance, really looking forward to those interviews today. Also, Tom, public service announcement, you are beating me in the TV Newser March Madness bracket. You're 28 out of 39. I'm 37.
Oh, I feel wonderful.
I'm in 37th place. Yeah, brutal for me. Tom Keene, thank you very much. And that brings me to what I'm watching. It's the Final Four this weekend. I may be losing pretty badly in the TV Newser bracket, but I do have Villanova going all the way in my Bloomberg bracket, BRKT Go, on the Bloomberg terminal. So Villanova, of course, playing Kansas first on Saturday, then UNC Duke. I'm obviously pulling for Nova because I have them winning. And I think I'm rooting for UNC as well, just to make Paul Sweeney a little angry, Matt.
Oh, that is not nice. He calls this tournament, instead of the Sweet 16 or the Final Four, he calls it the Duke Invitational. Of
course he does.
We'll see what he has to say about that this afternoon. I am on the radio with Paul Sweeney every day from 10 to 12. I'm watching really inflation, and there are a number of hot spots around the world where I think you're starting to see real problems. In Sri Lanka, there were protests, I believe, at the palace there that have turned into conflicts with the National Guard. So these are pictures of those protests. And, you know, the concern about the cost of living in the UK is also one that could bring on some unrest, Anna.
Right. Well, yes, certainly it's a focus. It's a political focus. It's a real talking point. We're watching the UK's cost of living, and particularly today because there's a cap on the highest bills that UK energy consumers can pay. But that cap has gotten up today. This is how you heat your home, how you power the electronics in your home, of course. The energy cap has increased to reflect, of course, what is going on in markets. It gets reviewed every 6 months. 50%. It'll be reviewed again in October. And this obviously could have an impact, a really big impact, along with planned tax rises on the UK cost of living. Lots more ahead on Bloomberg Surveillance. This is Bloomberg.
When you think space, you probably think
One space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Uncertainty surrounding economic, inflation, and labor market outcomes.
As you have to price in even more Fed hikes, that's going to challenge the growth narrative.
What the yield curve is discounting is higher odds of a growth slowdown next year.
As this recovery matures, what we expect is a shift in consumer spending.
There is demand destruction that's occurring, and there is substitution that needs to happen.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is Payrolls Friday from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures up 0.5% on the S&P. TK kicking off Q2.
Kicking off Q2, we're going to do that on this Jobs Day with Dominic Constant. Will join us here in a moment. Truly one of the giant intellects of Wall Street. And John, there's so much to talk about here in the markets, how it links into this job economy and how it links into the one common stunning shock of Q1. And I'm going to pick a number, John, that you picked the other day, 7% inflation.
And look at Europe too, Tom, through 7% for the first time ever. How big is this problem? How global is it? And how central banks will respond through the next several quarters, Tom? That is critical. This bond market's already making a move. Let's talk about that. Your two-year yield up through March, 90 basis points higher. Through the year so far, up 160 basis points through the last quarter. Tom, that's a monster move. How much more still to come?
It's a second wave. Dominic Constant makes real clear this is a second wave that we've seen, and he makes clear there could be a third wave. John, is that the mystery of Q2? Everybody's looking for rate stabilization. Maybe there's a setup like Steve Major at HSBC where rates rationalize. Constant goes the other way. That could be the surprise come June 30th.
Looking forward to that conversation. 2 hours, 30 minutes away, we get some jobs data. Lisa, the estimate 490K.
People are looking at what goes on underneath that. How many people are coming back into the labor market to capture some of the higher wages? How much does the participation rate go up and the unemployment rate fall to some of the same levels that we saw at the pre-pandemic lows? How much do we see that robust labor market really continuing to fuel a recovery and, frankly, pushing the Fed even to go faster?
And Lisa, catching up with the White House a little bit later on the oil market, crude back at 100.
Why are they releasing 180 million barrels? What is the longer-term plan? How much are they going to actually fine oil majors in the United States and oil drillers in the United States for not using permits on federal lands that are not certainly being tapped? What is the overall cohesive policy? That's what I'm curious about.
Do you remember what happened when Tom asked what is the Granholm plan of the energy secretary? And she laughed in his face and said, look to OPEC. Now we're finding out what the plan is.
This is a very convoluted message from this White House. How do they actually get some sort of cohesion in how they push this forward?
This is right where I want to go with Hochstein. What's the plan, John? And we're going to get a lot of happy talk. What's the plan?
Bully the oil majors. in this country, apparently, Tom, because before it was blame OPEC and now it's blame them. It's going to be a fascinating conversation a little bit later. Absolutely. Have they got any evidence of price gouging whatsoever? Because they keep talking about it. Tom, let's get them to name names. Let's talk about the companies before they go in front of Congress next week. Otherwise,
well,
are you saying it because it exists, or are you just saying it because it might play well with the electorate?
End of the weekend, that's a domestic strategy. But, John, before this jobs day, let's make it clear. Germany, Russia is tangible and way more immediate than what's going on in America.
On gas payments, we'll talk about that a little bit later, Tom. Futures up 0.5% on the S&P, on the Nasdaq 100. Elevated also, kicking off Q2 and a month of April as well, up 0.6%. Yields up 6 basis points, back through 240 on a 10-year, 240.23, and crude essentially unchanged, Lisa, $100 and about 31 cents.
Today, very much front and center is that 8:30 a.m. U.S. payrolls report for the month of March. You've been talking about the estimates, John. They do range from zero, I think, from Pantheon, up north, well north of 550,000. The estimate is 490,000. The estimate for the unemployment rate is for it to fall to 3.7%, a new post-pandemic low. I really want to understand, though, how much wages are driving more people into the market. The expectation is for a 5.5% hourly wage increase year over year. But, Tom, you've been pointing at this on a real basis. They are still lagging behind inflation and lagging behind at an accelerating clip. The manufacturing front is interesting at a time where, yes, we have COVID rolling off, but then you have, of course, the influence from Europe. At 9:30 a.m., we get U.S. auto sales. How much do we start to see ongoing weakness, frankly? People have already bought cars. They don't want to buy cars. You see that the prices have come down from the accelerating pace in terms of how quickly they've been rising on the used car front. The expectation is for the worst quarterly decline in auto sales going back a decade, just to give you a sense of what we're looking at. At 10 a.m., we get ISM manufacturing, again at a time where you get these dueling factors. Yeah, COVID is ending. On the other hand, you're getting a real pressure globally because of what's going on in Ukraine. And John, what's going on in China? Because COVID's not over there. And we actually saw the biggest decline in a private gauge of manufacturing overnight in China, going back to the heart of the pandemic.
Bramo, thank you. Let's stay on China and talk about what's happening with China for the stocks listed here in the United States. Alibaba in the pre-market shooting higher in early trading off the back of a Bloomberg story which reads like this. Chinese authorities are preparing to give U.S. regulators full access to auditing reports on the majority of the 200-plus companies listed in New York as soon as mid this year. Tom, that could be a big concession that keeps these guys in America.
Deal. It's a huge deal, and the key thing is the time frame. Mid next year in the accounting business is like tomorrow. And the answer here is Alibaba. You look at them as funneled through the Grand Cayman Islands, and there's always been that but about accounting. And here we are, John, with a real sea change.
Tom, that Bloomberg report sending the stock up by around about 6.5%.
Okay, let's do this. We're going to start Jobs Day right now, and it is our absolute joy to have the first interview with Dominic Constam of Mizuho. Thomas Hartnett has hit the ball out of the park, over the turnpike, over the cask and flagon, with hiring Constam, who is literally legendary at Credit Suisse, then at Deutsche Bank and Citigroup as well. I don't know, John, I think Constam retired for 5 years or something. He went out fly fishing or,
Is that what he did?
Who knows what?
I think Dom can speak for himself.
Constam back in the game on this Jobs Day.
At Mizuho, and it's good to catch up with him now. Dom, let's start with the bond market, and welcome. It's great to see you in a new seat. Let's talk about why you think yields have not peaked here. Why?
The way we've been approaching the outlook is obviously it's hugely uncertain, but you have these sort of different regimes. You have this idea that, you could be stagflation, you could stay in a very strong growth, strong inflation regime, and obviously some people are worried about some sort of recession. And basically, I think the very strong growth and strong inflation is going to stay with us for at least another 6 months. That's the way we've been sort of estimating it. And then I would actually give a lot of credence to the Fed outlook that eventually inflation will come down, but growth will be quite resilient. So on that basis, we have a view that the 10-year yields, they need to still go a bit higher, probably around 3%, before you want to sort of dip your toe in and try and call a top in the market. So that's essentially the view.
Dom, what gives you confidence that growth is that resilient at a time where on the margins you are seeing some consumers pull back and confidence has been plummeting?
Well, obviously there's a lot of uncertainty from the consumer side of things that's clearly going to affect confidence. But I think the key thing that people have focused on for being concerned about a preemptive slowdown in growth have been things like the fiscal cliff, for example, perhaps oil prices. But the consumer balance sheets or the household balance sheets are obviously very, very strong. They've got a lot of savings, and as long as they're willing to use those savings, then that's fine. The other key thing is the labour market. Obviously, it's absolutely off the charts. I mean, in all the years I've been working in the business, and it's been a long time since you've seen the labour market this impressive. And it's not just the job numbers and the unemployment rate. It's the fact that wages, nominal wages, have been going up so strongly as unemployment's been falling. And you're quite right. Real wages aren't that good because inflation is a problem, particularly on the energy side. But as inflation comes down, real wages are going to go up quite a lot. So there's great scope, if you like, for nominal wages to sort of moderate in their growth and people to still keep their jobs. And you look at things like the beverage curve, which is how hard it is to hire people for companies, to match people to the job. They have to offer more vacancies to get any particular job filled. All those are obviously very signs of a very robust labour market. And I think the key point for the Fed, why are they tightening? When people say, okay, they're tightening, are they going to force the housing market down? Are they going to create unemployment? No, what they're tightening for, I think, is to make the wage bargaining process a bit more orderly so that as people return to work, they're not returning to work at ever higher wages. That they're going to sort of moderate the wage inflation. And basically, there may be a slight increase in unemployment, but you could have the best of all possible worlds, a soft landing where wage inflation comes down, inflation moderates, and people basically keep their job, and the housing market doesn't fall to pieces. And that's kind of the Fed's view, and I think at this stage, it's too soon to say they're wrong. And on that basis, I think bond markets, they've only, in the US, they haven't even got back to where they were pre-COVID. If you look at the 2016-18 averages, we're still 25 base points off those numbers. The global markets have, they've all done it, but not the US. So I think the US market still has room to move higher. The flattening is obviously with us, but it's too soon to call a trough in yields in the US.
Hey, Dom, fascinating stuff and great to see you in that seat. I'll say it again, I'll say it twice. Dominic Constant there of Mizuho Americas, the head of macro strategy. Morgan Stanley put out a nice piece in the last 24 hours or so. Alan Zentner getting together with the equity team and putting out a long research piece. I'll just pick a couple of lines from it. Price increases to offset higher wages may soon lose steam as demand destruction is emerging in consumer end markets. It may pose a risk to corporate profit margins. Is that the story, Tom, for 2022?
I think it's out there front. Ellen Zentner with Francine Lacroix on Lake Como this morning. I think she's fly fishing after the interview. But John, this is a really important point again for this second quarter is do we see demand destruction click in? And as Dominic said, not to get into the beverage curve right now, but he is heated that we are returning to normal labor economics with a reemergence of the Phillips curve. John, I haven't said that, I think, in 4 years, maybe 6 years.
Are you heated about not being in Lake Como?
No, I'm not, because heated is it's like snow. It's not nearly as romantic as you think. There's slush and the wind goes horizontal out of the Swiss Alps. Francine has like 3 space heaters, John, and they don't work.
I will say it's best to go to Villa d'Este in the summer.
Yes.
Tom, you'd agree with that too. Futures up 0.5% on the S&P. The Nasdaq up 0.6%. Yields higher by 7 basis points to 240. They do a great breakfast too, Tom.
They do.
Fantastic. It's a jewel. A great breakfast. 490,000 your estimate for payrolls. That's coming up a little bit later. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Bloomberg's learned that the UK has agreed to join the U.S. in releasing oil from its strategic reserve. No word yet on how big that release will be. President Biden announced the U.S. will release 1 million barrels of oil a day for 6 months. The goal is to lower gasoline prices and reduce dependence on foreign oil. Ukraine says direct talks with Russia are set to resume today. These negotiations will be by video link instead of face-to-face. Meanwhile, Russia says that Ukrainian forces made a rare strike across the border. 2 helicopters hit a Russian oil tank facility.
Economists surveyed by Bloomberg expect another strong U.S. jobs report today. The median estimate is that employers added 490,000 jobs in March. The unemployment rate's expected to fall 0.1% to 3.7%. The jobs report is out at 8:30 New York time. Shanghai has started part 2 of its phased lockdown. It's confining some 16 million people living in the western part of their city to their homes. A 4-day lockdown of eastern Shanghai, that just ended. During the lockdown, residents are barred from leaving their homes unless they're going out for mandatory COVID tests. The upstart Amazon labor union is on track to possibly win a historic election to unionize a warehouse in Staten Island, New York. When vote counting was halted last night, votes in favor of the union outnumbered those opposed. The final tally comes as early as today. Meanwhile, Amazon was ahead in a similar election in Alabama. Global news 24 hours a day and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
Crypto
You have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
The jobs report last month beat estimates.
We have a very tight labor market. It is pretty clear.
Historic recovery in our labor market.
One of the best labor markets in a generation.
Today, Tom, John, Lisa, and Mike will bring you the data and analysis as the numbers cross the Bloomberg.
More people are coming into the labor force. It's going to decelerate the wage gains. Is that good?
As the Fed looks to contain inflation, and it's really important that the jobs recovery continues.
The March jobs report, today on Bloomberg Television and Radio.
Today, I'm authorizing the release of 1 million barrels per day for the next 6 months, over 180 million barrels from the Strategic Petroleum Reserve. This is a wartime bridge to increase oil supply until production ramps up later this year.
The President of the United States on the latest effort to do something about gas prices. Futures up 0.5% this morning. Good morning. That was worth a move of about 6 to 7% on crude yesterday. This is how we're shaping up this morning on WTI. $100.41. We're positive about 0.1%. Yields are higher by 6 basis points to 240. Look out, euro dollar, negative 0.1%. 110.53. CPI in the Eurozone, 7.5%.
Yeah.
This just on Twitter, Tom, from Marc-Andre Fongen, who says the following. Only 3 things are certain in life. Death, taxes, and the ECB not having a clue.
Well, the ECB will be interesting here. We've talked about that a lot. John, did you see Jeff Curry overnight reaffirming 115 oil at Goldman Sachs? And he tore to shreds the SPR theory.
What did he say about it, Tom?
He just says, look, it hasn't worked before. Why is it going to work now?
Because they're doing it bigger this time, Tom.
Yeah,
180
the
million
magnitude's
barrels.
there. Okay, fine. But, you know, the great microeconomist from Chicago just says, no, it's silly.
That's their argument, not mine, of course, Tom.
Yeah.
I mean, here we are, still at 100.
Well, okay, 115 is not that far away. Right now, let's get to it. Maria today on Budapest for an important election. But first, Emily Wilkins in Washington. Emily, what does day 2 of this SPR release look like?
I mean, at this point, it's looking like the White House really trying to give an answer to the pressure they are feeling on gas prices. I mean, look, this is a dual-pronged move. Yes, it is coming in regards with Putin, in regards with Ukraine, in regards with trying to help some of the European allies. But it also comes as the Biden administration is getting heat from the American people for these high gas prices. You know, the administration, they've tried to brand this as Putin's rise in gas prices. They've tried to blame big oil companies. We'll see more of that when they come before Congress next week. But there's a Quinnipiac poll out this morning showing that 41% of Americans are blaming Biden directly for these high oil prices. And they're only about 24% of them are blaming Putin or big oil companies. And that clearly shows that the blame's falling on the president's shoulders. And this is something the White House is just trying to get under control before the midterms later this year. Democrats already face a very difficult election, as the party in power always does for midterms. It's only going to get worse if the American people continue their low approval of the Biden administration.
What happened to blaming OPEC? There was a Wall Street Journal report a number of weeks ago that the White House denied, said was inaccurate, to be precise, that essentially the administration had reached out for a call with Crown Prince Mohammed bin Salman, and that was rejected. Now, Emily, where are we with those talks? Where are we with that outreach? Because for many, OPEC are laughing in our faces here. They've had another meeting recently. It didn't last very long. The one earlier this month lasted 13 minutes. Where are we with the relationship between D.C., the White House, and Riyadh?
Well, those reports that the White House had reached out to those countries really sent shockwaves through Washington. There were a lot of people who were saying, you know, we should not be asking these countries who we're not allied with, who we, you know, have these concerns about, to be the ones to amp up oil and gas production. And a lot of Republicans are really hitting Biden on this point. They're saying it's the U.S. that needs to be the one to have energy independence, to really step up production here. And you kind of saw the Biden administration touch on that a little bit yesterday, saying that they they were calling on Congress now to actually fine companies that have these drilling permits and are not using them, or have these areas of public land that they're not using to produce oil and gas. So it'll be interesting to see how that moves through Congress. We know that lawmakers there are currently working on a whole package of bills, trying to find ways that they can nudge the price of gas a little bit lower.
Maria, meanwhile, over in Europe, we got this out of the Kremlin this morning, that ruble payments for gas will be due in the late April, early May kind of time frame. What's going on here? We already have had this tit for tat where basically the Euro region said, no, we're not going to do that. He seemed to roll over. I'm talking about Vladimir Putin. This seems like a different tone.
Yeah, and if you ask me, we now start to see the way that this is going to work. We know that Gazprom, which, by the way, has never breached their contracts in Europe, we should know that, not during the war and not before the war. What they say is clients will have to have two bank accounts. So they will have to have one in euros and then another one in rubles, and they would be responsible for the swap. So this goes back to what Mario Draghi said yesterday. He had a phone call with Vladimir Putin for an hour. The Italian prime minister asked him for details, and he briefed just that they would pay in euros, and then Russia would be responsible for the conversion. So at that point, nothing really changes. And by the way, when you speak to critics here in Europe, particularly on the energy front, they tell you whether you pay in euros or whether you pay in rubles, in the end, it doesn't matter because Russia is making money out of this. And this is the way they finance a war. So a lot of this is a political fight, but in real terms, it's not really changing anything because the flows are still going. Russia's still getting paid, and the Europeans still buy the gas.
Maria, I just want to finish on this. There was outreach from Zelensky. There's been many addresses to parliaments around Europe. There was one specific moment that jumped out to me. He went through countries, through Europe, piece by piece, one by one, and talked about Ukraine's relationship with them. Then he got to Hungary, and he had a message for Hungary's leader. Where is that relationship?
Well, that moment, Jonathan, I was in Brussels when it happened. This was a video conference in which Zelensky jumped in with all of the European leaders. President Biden was also there, and everyone's jaw just dropped. This was a moment in which he said, Viktor Orban, you're not helping us. You're with Russia, and it's a moment of truth. You need to figure out what you want to do here. You're either with us or you're not. At this point, I would say this is a relationship that's broken, and it's broken as a result of the war. Viktor Orban in this country right now says that he's the only one that can keep Hungary neutral. He's the only one that can prevent the war from slipping over into the Hungarian border, and he's presenting this as, I'm the man that's going to keep our country safe. But of course, a lot of this is, you could argue, also propaganda. You know, Hungary as a country is a member of NATO, is a member of the European Union. There is no way they would fight this individually. And a lot of this is going back to his very own personal contradictions about his friendship with Vladimir Putin, going back to 10 years. So the relationship, if you ask me at this point, is completely broken, not just with Ukraine, but also Hungarian neighbors. If you look at Poland, a very different country, these two are usually together and work together, not this time around. It's a war that has really created a lot of frictions in Eastern Europe.
Maria, thank you. In Budapest for the elections. Maria Tadeo there, alongside Emily Wilkins over in DC. TK, have you been able to follow this spat over how to pay for Russian gas?
You know,
does it make sense to you?
Buried in the depths of CFA level 2 or 3 is a dark, dark chapter where your eyes glaze over. John, you have to have a beverage in your hand while you study. And the answer is I was listening to this, all it comes down to is a foreign exchange swap, which is very complex, and it's the time, and the key thing for me now is the ruble truly priced at 82. To me, that's a singular Germanic question.
Futures this morning, up a half of 1%. Good morning to you all. It is Payrolls Friday. Your estimate is 490K, your number 2 hours away. This is Bloomberg.
companies know they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Futures positive this morning on the S&P as we kick off Q2. On the S&P 500, up 0.5%. On the Nasdaq 100, up 0.6%. Was that really the first quarterly loss in 2 years? On the S&P, Bramo, was it really?
It's just amazing how
I can't
much.
believe that.
I mean, I can't believe it either. I think the distinction here is that everything else lost even more, which gives you a sense of just how painful this quarter's been.
Bouncing it back a little bit this morning. Bouncing back through March as well. A decent month of gains for the month of March. On the S&P 500, the first monthly gain of the year so far. On the month also was this massive move in the bond market. Treasuries, 2s, 10s and 30s, and looking at the front end, a move of 90 basis points on a two-year yield in a single month. Right now, 237.53, up another 4 basis points on the session. On 10s, up 6 basis points. The curve just a little bit steeper. The difference between the two, I think you can do this for yourself now, Tom. About 2 basis points, the difference between 2s and 10s this morning.
Yeah, even I can do that math here. But, you know, there it is. It's a huge deal for the Q1. Where do you, John, I can't imagine. I can't frame in my head, John, June 30th.
We could be 100 basis points higher on the Fed funds rate by then, Tom.
Yeah, no
idea.
Fascinating stuff. I mean, look, that's the base case now, isn't it? That is the base case. BNP, another one, 50 basis point hikes. The next meeting, the one after that. That's the base case now. What about the ECB? Finish on euro dollar. The ECB, I'm sure, was surprised this morning by inflation. The previous month had a 5 handle. The expectation today was a 6 handle. We got 7.5% on CPI. Euro dollar 110.57, just a little softer here by 1/10 of 1%. TK, what does the ECB do? They're still doing QE, and it probably won't end until Q3.
Yeah. We will have to see. This is a great joy, as we had Dominic Constant with us earlier in his first interview with Mizuho, the legend from Credit Suisse. Right now, the legend from the Federal Reserve. At Williams College, mathematics is front and center. They have an acclaimed math camp. And what you do if you're better than good at math at Williams College is you go east, young man, and you pick out a school in Boston where you further it forward. That is what one David Wilcox did with prodigious ability before serving 3 Fed chairmen at the Federal Reserve. He is Director of Economic Research for Bloomberg Economics. Dr. Wilcox, thank you so much for joining us today. Let me cut to the chase on the jobs report. It is the first and second derivatives of wage growth. What is their character right now?
Well, all the indications, Tom, are that the labor market is behaving like it's very hot. Wage gains are galloping along at a clip that we haven't seen in several decades. We're expecting a sizable employment report, employment gain this morning, and probably another downtick in the unemployment rate. Employers are really eager to hire, and what that means is that they're offering prospects a nice gain in their wage envelope.
Dominic Constant talks about the return of the Phillips curve with beverage curve effects. I haven't said this, David, since, I don't know, 2 chairmen ago. Has the Phillips curve returned the relationship and the tie-in of the wage growth, I should say, with inflation, with jobs, and indeed with economic growth?
Well, I'm in perhaps a minority who thought that the Phillips curve never exited stage left. It's one of the sturdier relationships we macroeconomists have to rely on. And what we see is that when the economy runs hotter, we usually see a little bit faster wage growth, a little bit faster price growth. It's a noisy relationship, so sometimes it's hard to pick out from all the background activity that's going on. But I think we're seeing strong evidence of that operating right now.
Are we seeing the limits of it as the price increases that people are seeing in stores are outpacing so dramatically those wage increases, and you're starting to see a little bit of consumer hesitance on the corners?
Yeah, it's a great point. Price inflation is causing hardship for tens of millions of American families. Their purchasing power is being eroded by what they have to pay at the gas pump and at the grocery store. So there's no guarantee that earnings are going to outpace price increases. For that to happen, we need to see really solid productivity gains.
So you were at the Fed. You know how they think. I've been really struggling with this idea of profit margins. If they continue to climb, is that a bad thing for the Federal Reserve? Is that not what they want to see in terms of them being able to pass along all of the price increases to consumers, which has really helped support their earnings?
The main factor the Fed is going to be focusing on is whether inflation seems to be becoming embedded in the general psychology. What's a red flag for any central bank, including the Fed, is when businesses begin to say, I know I can pass on my cost increases to my customers because my competitors are doing the same thing. It's a red flag for a central bank when workers say, I know I can go in and demand higher wage increases on an ongoing basis because if my employer doesn't give it to me, I can go down the street and get the same job at higher pay. That's when they know they're in deep trouble.
David, I want to move from the jobs report over to the question for April and frankly Q2, and that is whether Christine Lagarde, with all the challenges, all the original theory, if you will, and practice of the European Central Bank experiment. They have a massive conundrum right now. How does Lagarde move forward given 7% inflation, which is unspeakable to begin with in Germany?
It's a tough situation for central bankers all around the globe. Ms. Lagarde faces a situation not that much unlike Chair Powell. Up until now, the U.S. really has stood out by having higher inflation than other countries around the globe. What central banks now need to do is attempt to judge what the staying power is of inflation. If, as still remains in my mind the base case, inflation recedes as the economy continues to normalize, then central banks are going to need to do less in terms of crushing the economy in order to bring it down. But most of all, what's required to run a successful monetary policy is for central banks to continually adjust to unforeseen developments and circumstances. They're just like a rocket engineer, always firing the thruster rockets to get back on course.
Okay. Is the thruster rocket to get back on course the utilization of foreign exchange? Are the dynamics of the euro or the dollar the same now as they were for Rudy Dornbush a few decades ago?
By and large, the answer to that is yes. And for central banks around the world, including the ECB and the Federal Reserve, an important channel of monetary policy is through that foreign exchange rate. When they tighten financial conditions, one thing that happens is the currency appreciates. That makes our products more expensive for foreign countries and that tamps down demand. That's all part of tightening financial conditions.
David Wilcox there of Bloomberg Economics going into the payrolls print a few hours away. David, thank you. Great to catch up with you on this show this morning, on this payrolls Friday, looking for something close to 500K, 490,000. I think Goldman at the top end, Tom, pushing 600K. And as Lisa mentioned, Pantheon at the low end at 0. So you've got 0 all the way out to close to 600K.
You know, Ian's not thinking clearly because
is that right?
You know, Newcastle Tottenham is just too much tension for Ian.
This Sunday, Tom.
This Sunday as well. John, what's important here, let's remind ourselves, normal back before our set of crises was, say, 200,000. And I remember when people would even model 150,000 is quote unquote normal. And we're still popping 400,000, 500,000 in a great recovery clip.
Is there anything normal about this moment, Tom? You mentioned Europe. Let's talk about that for a moment. 7.5% inflation, a depot rate at negative 50 basis points, and still running QE out to Q3.
John,
can you just join the dots for me there, Tom? Explain to me how that makes sense.
You go down my hallway where my books are from the west wing to the east wing of the house, and it's real simple. David Wilcox studied under worked, I should say, under 3 Fed chairmen, and in there somewhere is my son's textbook, Abel Bernanke. None of this is in Abel Bernanke.
You can call it a supply shock, Lisa. You can call it an energy shock. The energy story making up the bulk of the move in Eurozone inflation, but ultimately policy and the fundamentals on the ground are totally out of whack right now in Europe and in the United States too.